Good morning, guys. All right. Well, I guess I didn't miss us just going right back to 75 again. Oh, Jesus fucking Christ. Yeah, the options interest this morning looks about the same. I posted it in I posted the gamma charts for this AM in Pickles Picks, by the way. Good morning, John. Make gray look sexy. This is actually all right. It's probably gray. Maybe if you're really good later, I'll roll my sleeves up, Carl, and I'll show you my forearms. Should have held more. Oh, yeah, because Cat fucking ripped in the AM. It's my favorite. I'd love a good morning shaming on why my Nespresso pods are garbage. Mm. I mean, it's a step up from Keurig, but it's not espresso. I watched a Deloitte webcast yesterday. According to their surveys, consumers plan on spending 14% more this holiday season. Good for them. And where are those consumers going to get that money? Did you just not report earnings this AM, or is it delayed because of Hawaiian time? I think it was supposed to be this AM. Yeah, Tesla looked kind of good last night, and this is why I didn't play it. It just immediately shot the bet at market open. There was all kinds of 0 DTEs on it. Or, well, 1 DTEs. Don't forget to like the stream, my dudes. Thanks a lot, souls. John Wilkes, credit cards, because that's free money. Those are getting pretty maxed out. It's cat looking like above 237. I mean, it's better. Indexes are falling off a bit, though, so cat will probably get kind of hammered from that. Let me take a look. Yeah. Still sold calls at 240, which is a problem. I don't really know if there's a solution for that. Cat's been having a hard time getting the momentum to really break through those sold calls. I mean, it broke through the 237.50s this morning, but I might fall back under them again here in a second. That looks pretty bearish so far today. A lot of sold calls. Just a Actually, a shitload of sold calls. I know pumpies. Too much resistance. So the last few days, the bulls have really had a hard time getting above 390, 4390 because there's no liquidity and they're fighting back against the market maker. It's making it really hard for them to get any momentum. That and the calls above 4400 and at 4400 are becoming increasingly sold versus bought. So it's been a bit rough on the upside for the bulls. Holiday travel is increasing as well. I think Deloitte might need to survey other people. Chop here, you think SCX could break 4350 today? We'd probably chop. I'd say we're pretty range bound between 75 and 90, and probably more like 75 and 85. It was all morning de-risking. Could have been, yeah. I don't think a lot though. I think there was some profit taking on calls around like excuse me, 954. Um, and that kind of ended around 10 o'clock. And since then, mostly calls being sold out of the money again. Sold calls at 4,400. Yep. Yep. As a former Deloitte employee, we live in a society. Not SVX. I'm talking about SVX. Cat's got sold calls at 240. I don't know if they're going anywhere, but the dropping indexes aren't gonna help it build momentum over that range. What's up, Dork? When red candle, I mean, it looks like we've had two really nice sets of red candles. Are you talking about downside red candle? Red candle to 4370? I don't know. Yeah, like red candle. I can. HSBC gave a PT of 146 on Tesla. That's fun, right? It's actually kind of accurate. A little high, but huh. Ooh, that's spicy. My favorite trade of Gherk makes six figures playing cat a year ago. Justifies buying $15 t-shirt with cat logo. I wanted to celebrate a little. No one de-risks Mag 7, sadly. No, that's not the way it works. Mag 7 concentration to the moon. You're getting in on this new AMC share offering. Adam Aaron's selling 350 million worth of fresh ones. Really? The man just can't be stopped. What if they can't break 100%? Is the Nvidia play dead? I mean, it fucking opened up like $5 or $7 higher than close, right? It's holding 75. I guess you could have played open until now, but That was a kind of a different $5 move. Yeah, I'd probably stay away from it. You could try playing the downside back. A little risky though. I was in risk management. Now I'm here. Ironic. To break 100%, you can just add more than 100%. Let's say like 101. But then you need a new thing that needed to be made whole. $10 move on SPX incoming. Can you let me know which direction? If we break 75, that's pretty bearish. Although we really would want to see it break 67. I guess below 72 is kind of bad too. 72 to 67 is kind of bearish. Oh shit. Well, that's fun. Hmm. It's now a bad time to pick up some GLD exposure. Um, could be okay. What about Theta? I've been playing the downside in a video for months. It's not paid off yet. But if you keep sinking money into it, surely we'll win eventually. Didn't it go down like $100? Like just in the last month. It did. It went from October 12 high of 476 to a low of 392. I bought so many puts at that bottom. A whole lot of gaps to fill to the downside. Tell SPX to stop procrastinating and get to it. I don't think we're there yet. You gotta pay the troll toll to make the boys whole. Damn, man. I bought so many puts at the bottom. Oh, yeah. Is this a reverse head and shoulders? No. On what? I don't even know what you're talking about, but on VIX? What's your current Nvidia position? Still Jan puts. My my 350s, 420s got closed out like last month. But I'll probably enter more. I'm gonna wait till earnings. The earnings should be bad, right? There's no way they could meet their guidance without committing fraud. I still have the 200s. they're still worthless. The straddle thing has become routine. It's something you do, and oh, look at that money. Yeah, that's fun. I want to short BTC futures at these levels. Your thoughts? Suicidal or nah? Why? I don't know. If we're gonna have currency risk coming up, I probably wouldn't want to be short BTC. Is there any bounce for Tesla? It's drilling like Elon said something. Uh, it's not in a particularly good spot, and it fell below the long-term trend, where literally yesterday I said I would consider shorting it. It's pretty bearish for it to break down here. And the downgrade from HSBC probably doesn't help. The Jensen way. Did Powell speak already? 2 o'clock. Do you think the Powell speech is going to be straddled today? Probably. I mean, the market's kind of already straddled and strangled at this point anyway. The concentration of interest at 43.75 is ridiculous. There's a big bounce in bought puts. Sold calls here. We might lose 75 if they push a little harder. Wonder if that's worth playing. This IWM position. What's Siri doing? Ooh. Hmm. We got timed out for the truth about percentages, and I'm a bit salty. I think that was Carl. Boa still B of A? B of A is not insolvent. Siri tips getting freaky after that early move. Man, there's no point in watching the tips on it. It's got like a 600 or like 600 million share float. Sorry, 623 million share float. Yeah, it's it's never gonna get that illiquid. Can I ask where GN is today? It's on the fucking chart. You know that, right? The one I post every night. It's 43.34. But I always put it there. Siri has a new streaming app, but running has nothing to do with FTDs. I mean, today it probably doesn't have a lot to do with FTDs. There's not very many of them, right? Yeah, if they were to realize those losses, but they have no intention of realizing those losses, right? That's unlike their hold to maturity securities because bond prices crashed. Mm, the downside's a little bit better defended than it was yesterday, and gamma neutral's lower. So I'm not sure that a break of 75 is going to send us hurtling downwards, but it wouldn't be bullish. Also, call selling's kind of slowing down right here as we approach 75 again. If everyone rushes into bonds, won't those losses flip back to gains? I mean, those hold to maturity securities have yields that are significantly lower than the current ones, right? Calls are so fucking expensive. Are they really? I thought they were kind of cheap yesterday. Ooh, 72 is important. They're not too bad. A little pricey at the money, but that's because of Powell, right? On the zero on the zero DTs. You can get the one DTE. That's probably got better IV. Yeah, one DTE is like 14. I assume people have asked about real because a Google search for short percent list, it has the highest. But who doesn't love a $2 stock that's a brick and mortar store? Only kind of joking. I don't even know what company that is. The Real Real? They're an internet retailer. They sell consignment luxury goods. Oh my god. It's a pawn shop. It's an internet pawn shop. And they're proud of it. E-commerce pawn shops always been what I've always wanted to buy. Got him, dork. When a company issues reserve shares on an incentive plan, that dilutes the float, right? Yeah. Um, so it would increase the shares outstanding and then dilute existing ownership. I think that the impacts are probably more relevant on like ownership percentage and EPS than anything else. And the float won't change immediately, but I think as like the shares are vested or sold, then they can further dilute, right? So the impact to the float isn't immediate. Unless, I suppose, unless they immediately sell the shares, in which case it would be. But they probably won't. I'm sure they have some sort of lockout period. What was that 160K share sell order on GME? I don't know. Where? There isn't one. GME only has like 400K volume today. Dork, you're going mad with power again. Why are some bid asks on the spreads ridiculous? Like $5 spread. I'm trying to buy at the moment. The ask is like $8, $9. I don't know. What fucking illiquid options chain are you looking at? No, I'm not. I'm absolutely not buying any of it. Hmm. VIX is still ticking up here. This is kind of spicy. It's a decent amount of put interest at 70, but then it kind of falls off to the downside. Although we only need to break 67 for the MM to flip. I think we find some support. There might be one more sell-off, though. One more sell-off, and then we find support. Hmm. Excuse me, Greg. I'd like to request a negative 2% day. I'm not in charge of that. SPX 5 DTE. With spreads that wide? Where the where the fuck are you seeing spreads that wide? Deep in the money or something? Do you have Airbnb Greeks? Probably. What did you do to Dork? Why is he timing you out every time you say anything? No, don't answer me now. Answer me in 3 minutes. Let's see. Airbnb, Delta Neutral's at 136, GN's at 141. Neither of which it is anywhere near. And call interest is kind of falling off. Yeah, it might be getting ready to move down another leg. I heard Toronto was considering banning Airbnb. That was weird. After my experience with Airbnb this past week, I bought some puts, rage puts. Why don't you just stay at a fucking hotel? Are you having a bad quarter, popcorn trader? You can still see his chat, so I figured rate limiting him to one message every 5 minutes would be punishment enough for his Discord debauchery. Okay, that's fair. Vancouver did bear an Airbnb. Ooh. No, I needed a kitchen. Okay. It's good to have a kitchen. You can cook food in them. Hmm. A little bit of put selling here. Vancouver banned it. Toronto just placed extra taxes on it. I know Italy announced that Airbnb owed like 700 million in back taxes and then just immediately seized it from them. No offense to the folks from Rosemary Beach, but the food there is hot trash. Oh, was that in Florida? Moss is having a good day, regardless of a slight earnings miss. Yeah, that needs to bounce back still. EXR is still moving up. Did many of you guys get in on that? I don't know. Ended up being pretty good. Although I think the real estate market's going to get worse, and I'm definitely torn between taking some profits and buying back in later, and just holding it. Anything happened with HE earnings that I'm aware of? I don't even see a report for them. It's up 3%, so that seems good, right? Airbnb did that for their property owners too during the pandemic. Airbnb took 150K from my business account with no warning. I'm enjoying being in puts, making money off their drop in valuation. Fair. All right. Why the fuck did they do that? HE earnings are Hawaiian time at 11:30 Eastern. You're, you're joking, right? When Nvidia top, Nvidia could test like 480 still. It doesn't look like it's slowing down much. It's definitely not pulling back at the rest of the market, so. Maybe the earnings call, but they should have should have released the report pre-market. Yeah. I don't know. Why doesn't somebody Google it? It's easier to manage further dated spreads. Like way easier. Selling theta on spreads makes them far easier to manage. HE's earnings, Gen. Are bulls gonna turn this around here? They're trying. So probably. You hate selling theta? Yeah, I don't. I'm not a particular fan of it. I mean, I sell theta all the time, but as like a trading strategy, it's not super great. It's definitely not in. Yeah, it's good for getting yields, but they're slow, incremental. It's hard to scale. I do sell theta though. I sell like I have one of my accounts is just entirely an iron condor. That's all it ever is. You sell theta, but you wouldn't join a gang over it. Yeah. HE will announce its third quarter 2023 financial results Thursday, November 9th, and conduct a conference call to discuss the earnings guidance at 11:30 a.m. Hawaiian time, 4:30 Eastern. Citadel's Ken Griffin says world's peace dividend at the end of the road. What a nerd. I'm convinced the market is in purgatory. It's kind of just stuck to 43.75. No worries. At this stage of the day, are you out of the put side of your straddle? I think I got stopped out of it here. Hope I did. Yes. Although Monday and Tuesday's straddles ended up not getting closed till yesterday when we dropped to 43.60. Why? Why did you buy that, McChuggets? You don't know anything about it. So chop until 1 p.m. for the 30-year bond auction. That's today, right? Yeah, but then Powell's speaking almost immediately after that at 2 o'clock, right? He moved his entire hedge fund to Florida to dodge taxes. Oh, I know. 43.80 test. Breakthrough to 43.80. 82, 83, reject down to 43.75, bounce, then down to 43.72 forever. Yeah, yeah, you pretty much nailed it. Hmm. Do you still like SRUF? I want uranium exposure. I have none. Okay. Would have been better at like $12 when I was buying it. Um uh yeah. If you can buy it at a discount to NAV though. Omegle finally shut down yesterday after 14 years. What's that? Disney Sports Network from cable to streaming has vexed Iger since the unit makes up a third of Disney's operating income. Yesterday, Iger said ESPN's direct-to-consumer shift needs a soft landing. Huh. Yeah, they missed on revenues. Fubo? Interesting. But you think they buy out Fubo? OTD because it's OTC? I don't know what the fee is, but there could be one associated with buying OTC stocks. I don't have TD. Stop. What did I troll about? No idea. I just think Fubo looks cheap. But Fubo's pretty expensive right now. But like over the last 30 days, it's up. Is it? Well, maybe it's not. Was that before? Did it run up before or after? That's just wrong. Hmm. Interesting. Yeah, I don't think Fubo is particularly cheap right now. Amazon should buy Fubo. Good morning. The stream card is glorious. Thank you. I'm glad finally someone said something about it. I started wheeling Ura for my uranium exposure. Just tuning in. Thoughts on another pump as high as they can to de-risk before auction and Powell. Possibly. I'm not really sure how high that would be, though. There was some put profit taking at the bottom. Now it looks like there's some put selling, so they might try to pump it back up to like 85, 90. Might be a little hard to get over the hump at 80, though. Could just get fucking hung up and trade sideways again. Thanks for the advice. Who's your daddy? Would a rejection at 380 be bad for bears or not make too much difference? A rejection at 380? Why would that be bad for bears? I mean, the only price that really matters at this level is like 43.75. There's still a shitload of calls at that strike. So it's we're going to keep getting pulled back to it. Hmm. Fucking call buying and call selling are just bouncing back and forth again. Do you think we see 500 on Nvidia this year? As of last night, the call interest kind of topped out at like 480. It's getting pretty close to that now. On a longer time frame, when would you think we test the next level down? I'm curious your thoughts of the indices making a new high here and what that does to the downtrend. I don't think indices have made a new high here. Like if you go out to the monthly on SPX, right? Um, I think we're still below the high from October, 41 or 43.93.57, 43.93.40. So this morning's rejection still whiffed October's high. Ooh, we're breaking 80. Bought real for two reasons. One, pawn shop usage increases during economic downturn. Two, I want your approval of making smart financial decisions like Ryan Cohen. Oh, Jesus. I got a Ashiatsu massage yesterday. I thought I was going to be a 5 foot, 120 pound Asian lady. Quite the opposite. It's a 240 pound, 10 foot Asian man. White man? Absolutely terrible and awkward. What's the opposite of Asian ethnically? Huh. I don't want to go there. Non-Asian? Caucasian? ESZ3 high is 44.30.50. Okay. So, pretty sure Native Americans came to North America from Asia. By opposite, they meant that they ended up paying to give the massage. Oh, okay. Well, that's totally different. So it's more like a massage training course. There's no futures charts on Webull. Hey, there are, but they're 15 minutes behind, so there's no point in watching them. Holy shit, what the fuck just happened? They're giving it all they got, Captain. This is boring. put interest getting squeezed out a little bit? They're shorting the absolute fuck out of VIX. He whacked off the masseuse. That's kind of what I'm getting from the story. My work Roth 401k now allows self-direction. I'm so tempted to degen into it, but I'm gonna practice more thanks to your teachings. Okay, smart. That's probably a good idea not to just immediately degen into your retirement savings. My self-directed work 401k is solely Pickles picks, and I'm looking to be able to retire early. Nice. I can't tell if you're being super sarcastic, but if true, awesome. Land bridge theory is wrong, highly debatable. I'm not talking to you. Probably people sailed. Okay, that's fine. If you were gonna give me some other thesis, there would have been no further conversation. Yeah, that's possible. Cat play being moved to next week, do you think? I mean, cat might just rip tomorrow. It's kind of holding the 43 237.50 level, which is good. I wouldn't NVR. Totally semi-sarcastic. Not many long Pickles picks, so they're only part of the port. There's been like 20 or 30. I don't like bags. I don't want to sit around holding a bunch of bags. No daily today? No. I you're a dillionaire. You know I wrote one last night, right? Do you not read that shit? These V's are insufferable. Only because they're so weak. And they take like 45 minutes to be realized. Hercules, you picked a good day to oversleep. Your late night Pickles Picks update and analysis is so empowering. I learn so much every day. You're a treasure. Thank you. If you don't hold the bags, you can never be cast as the boyfriend in a rom-com when the girl goes shopping. Okay, I can live with that. How'd you like that dividend from our super secret, super duper stack? Which we have so many. Which one? Oh, I think I know which one you're talking about. I sold my call hedge, so we might be breaking 4,400 today. Nice. Excuse me, Gherk compliments are my thing? Why so many super secret stocks? Well, because they're our private stocks. Dude, what the fuck? We got $1.16 a share? Bro. Did they even fucking did they announce that in advance in any way? That's like 7.5% on cost. That's fucking nuts. I love it. To the moon, Dork. Birthday divvy, what it used to be. Okay, so sold calls are just rocketing here. I don't get it. Where are they selling them? 4,400? 4,390? Should I be selling calls too? FTT is up 50%. Neat. Trying to get their poor filthy hands on it, Doric. They need to find their own deep fucking value. I don't know how much deep fucking value is left, but is the interest above 44.10 increasing, or are those sold? I think they're largely sold. I think everything 4,400 and up is pretty heavily sold. But if that's true, one really good pump could squeeze them out, right? I drew down 79% of my port fighting the trend since Halloween. Why? I just made it all back because Lily's ridiculous. Lesson learned about trend fighting. Don't do that, yeah. You see the guy in New York with rat slippers? There's like 8 million people here, man. No. He's a fashion designer. I definitely don't know anything about him then. If you designed your own hat, does that make you a fashion designer too? Interesting. We should do a pickle runway show. My 4385p timing may not have been the bestest. Was it just right now? Or does Nvidia fizzle out on this ridiculous pump while the market has been pumping? 480. 480 was kind of the upside range. Just tested it. I guess I could squeeze out the calls at 480, so it might have a little more, but not much. In your experience, are expected moves a decent indicator of potential range? And market makers are usually pretty good at pricing the risk in the options they sell. Hmm. Sweet, I made 4 Gs on the pump. Nice, man. The sold cat calls weeklies, weekly and November 17, largely. No problem, Iceman. Follow up, using delta as a rough probability of going in the money. Any validity to that? I mean, those are the odds you're paying for, but I would say that you're probably overpaying most of the time for the perceived odds. So there's some validity to it, but not as much as priced in. I think bullish support's starting to break down a little bit here. I don't know. I don't know if I don't know if anything's gonna come in to stabilize the range. It looks like calls are mostly being sold right now, so. Is GME dead? It's not doing anything right now. It's still just being shorted. XRT's still on reg show. Where's the best support here? Yeah, even 80 is not really a great support. I think if we fail 85 here, we probably go back to 75, maybe even 70. Maybe this will make you think, wow, this is gonna fail super hard. I think everyone's kind of thinking the same thing, right? Like everyone's trying to fade the top, but that could just be setting them up to get blown out. I'm trying to be I'm trying to be careful with my approach to it because if bulls can find stability on delta neutral, we may like only pull back a little bit, right? And then they squeeze out all the interest that came in. Do you think of re-entering cat? Mm, maybe. I'm not sure yet. I've still yet to hear a valid bull argument. Everything's better, right? Goldilocks data, everything's perfect. Nothing to worry about. It's totally not two wars going on. Oh, no worries, Dork. I'll be good. Thanks, man. Mm. God fucking damn it. Same crime. It's not even a big candle. Hmm. Just try to buy back in cheaper. See if they fill the gap. All right, we got a little bit of put selling now. Yeah, so they're trying to hold 85. I don't think losing 85 is ideal here. USD JPY heating up. It's above 151 again. No, being on Reg Show doesn't limit the ability to short because ETFs aren't audited the same way as individual tickers. Yesterday at the dog park, a buddy told me a friend of his has just gotten into GME. Full on super stalker and everything. Apparently, he wasn't even in a coma in 2021 or anything. Okay. Oh, I already wrote about it. I'm not gonna fucking. I don't want to get into it right now. Just look it up in the. It's like in the announcements channel or something. Did Yuda say anything of substance last night? I don't think so. I didn't really check what he said. Kazuya told the conference central bank was making progress towards hitting its 2% inflation target, but cautioned that it was still too early to determine the sequence of its policy normalization. Oh, God damn it. When we normalize short-term interest rates, we'll have to be careful about what will happen to financial institutions, what will happen to borrowers of money in general, and what will happen to aggregate demand. It's going to be a serious challenge for us. They made some comments about China, warning of spillover. They said, I think they have enough capital to weather some increase in interest rates, but it's a matter of degree, so we'll have to be careful. If we can get 10 green days in a row, do you throw us a pizza party? No. Crazy pump and dump on BTC today. I saw that it was up like 5% or something. Any other comments from him? If we don't manage the process of phasing out YCC properly, we can cause huge volatility in the bonds market. We hope to be able to exit from this approach without creating such volatility, but we will see. I'm very interested what will happen in Japan's next round of wage negotiations in the spring. Interesting. Holy fuck, this is such a slow breakdown. Maybe in the next 10 minutes, we finally fail. What time does Powell talk? 2 o'clock. I swear we're in purgatory. Yeah, it's been an insanely boring week. VIX back to levels not seen since 35 minutes ago. Yeah. No, I don't think this is a bull flag. It's distributive. There's definitely some de-risking going on here. They're just trying to keep it in this range as long as they can to continue de-risking, right? What happens when GME goes below 10? It'll be below 10. This still feels extremely volatile compared to those hellish days of VIX at 12 and 13. Man, those days were easy, right? We just drop in the middle of the day and then V up into close. This is like multiple Vs. It's way harder. You're waiting till pre-SLD pump next week before adding back long puts on SPX. Probably, yeah. Although I've been picking some up with VIX this low. Revolutionary concept. All the slow de-risking this week, does that mean less spicy SLD or more spicy? I don't think it really means anything for SLD. Since Credit Suisse doesn't exist anymore, who's going to jail this time? UBS or Deutsche? Guess they'll have to be the new scapegoat. Bofa? Probably not. Ugh, getting way too much stability here. A little bit of call buying and put selling going on right now. It's gonna fucking break up. Fill the gap. Not filling the gap is kind of bad. What's futures doing? Just sitting at 4,400. Fucking lame. What auctions do we have? Or do we have any? We had 4 and 8 week, right? Those both came in pretty flat. We've got 15 and 30-year mortgage rates at noon. Still pushing back against future sellers at 44.05. Fucking bounced right off of the options wall there. The auction's at 1 o'clock. There's the gap fill. Tomorrow's expiration. Just trying to keep it off of the put wall at 80. No, nothing's really squeezing out. What's up, Rippin' Skulls? How would December long puts be fine? Would December long puts be fine for the next leg down? That might be enough time. Any GME news or projections? Not really. XRT's reg showed GME's are liquid and pretty heavily shorted. Although it hasn't run in months. Not a lot, at least. Oh, that squeezed out some calls. Cut this. Still have calls on the chain though. Is this just short calls closing? Ugh. Tomorrow's expiration. Okay, so just a shitload of calls for tomorrow at 85. We're kind of pushing that neutral point up to 85 now. I'm not sure if the Bulls won or we're just gonna see de-risking, but they're buying a lot of 85 calls for tomorrow. Is Jimmy Mass dead? I mean, it's been dead. It's been dead a long time. It's just a long-term growth stock play. Sure, you could say that. Very long term, or maybe not at all, because Cohen's an idiot. But Moas was the last 2 weeks on SPX. Do you think DFV's still in? I don't know. Maybe. Or he just sold everything in June. Hmm. Okay, some more call selling. Got profit taking on calls. Pulling up the 75 level. It looks like they're selling off the in the money support below 75. Which makes sense if they're trying to hold 85 into tomorrow. Short-term outlook on Fubo. It's illiquid enough that if Russell runs, it might get like another little pump to the upside. So far, Russell's been down for like the last 3 days, I think. Which is kind of shitting on its potential. The best part about GME is the SX cult actually killed the run. Well, Cohen killed the first round. The SS cult killed the cycles. I feel like there's no stopping this bull train on some really bad news from the Fed, the bond market, or Mag 7 guidance. The thing stopping the bull train is that there's just no liquidity. So we just keep bouncing in the same range. We might stay here for a while, but it's been pretty hard for them to get any kind of additional upside beyond 43.90, right? 43.85, 43.90. There's also still de-risking going on. So while there might be some bulls kind of FOMOing in, I think like the vol sellers are trying to get out still. A little bit of put buying, mostly profit taking on the call side. We all DRS our shares, then vote RC off the board. Would it be funny if they lost 43.85 after selling out the 43.75 support? They haven't sold out all of it, just a little bit. Hmm. We'll see how well the 85 support holds up here. I just want to roll my Jan 4380Ps and 4350Ps. I don't think you have to worry about that right now. When red God candle? Well, if we're gonna get it, it's gonna need to be in the next few minutes. These dip buyers to fuck right off. $396. puts us like right at 43.80. Hmm. Someone just sold a shitload of puts. Hmm. That didn't really do anything. I think they're gonna try to. They're trying really hard to stabilize it here without losing 85. I'm not sure it's working, but somebody just dumped like $250,000 in short puts. And picked up like 100,000 in call delta. Is Siri gonna short squeeze? Probably not. Most things don't short squeeze. Especially not super illiquid things. It could go up. That doesn't mean it's gonna short squeeze though. Yeah, there's some argument that it's a megaphone. We need to test the low here though. That would be like this trend. Ooh, IWM's pumping. Hmm. I think somebody ate up a big sell-off with short-dated options interest. That was a lot of positive delta for fucking no change in price. I captured some of the downside with my M hedge. Should I have just sold, or are we still expecting 14 sometime? On Macy's? That's just like a dividend stock. It might recover, but it's like accumulating right now. What do you got? IWM 11.9. Oh, interesting. What about SPY? They can't pump Mag 7 any higher, right? I mean, they can. It's just creates a lot of risk, right? Holy shit, Russell's green on the day. Holy fuck, this is so boring. Most importantly, banks are strong and resilient. Yields are up today. It's got to be tough to push back against. $30, $20, $10, $5. 30 and 20 are both almost up 200 BPS. Let's see if they step in to try to buy up the next sell-off. A lot of put interest picking up at 43.80. But not much at 85. And then 85 for tomorrow is kind of stacked. It's going to be hard to lose this level. 30-year auction prediction, over, under, spot. Probably not that impressive, given the 30 years ripping today. Oh, the yield's ripping. The 30-year itself is tanking. These guys are actually gonna, goddamn, risk off this time when we go to 4,500, right? I don't think we're getting to 4,500. Nope. There it is. I guess they didn't absorb this sell-off. Whoopsie. Hmm. Yeah, that looks like it's getting more bearish. I like that. Okay. I think if we break down through 85, we'll see vol increase more. Damn, IWM got curb stomped. NQ still positive. Yes, gonna pick up sellers under 4,400. Some pretty good volume on the sell-off. 12,000 contracts so far. I don't think we're going to 4,350. I wish. There's probably a really good chance we just get stuck at 85 here. Come on, more volume. Can blow up all their calls. You can't trade this. You just don't play the long side. I mean, you could definitely trade this. It's just irritating. I have 85 butterflies. This pleases me. Yeah, I don't think the risk pulled back at 75 is significant enough for us to crater or anything here, but we might pick up some volume to the downside if we keep pushing further away from 85. There's a lot of puts at 80. Hey, there we go. Need those future sellers to come in under 4,400. That'd be really cool. A test of 43.90 on futures. I'm scared Powell's gonna say something bullish. He might. He might just be more hawkish. Hmm. This deserves to tank. Too many green days in a row. It's like roulette, right? Like it's like you can have an infinite number of green days in a row. That's ugh. FinTwit analysis. God, I hate that. 500 BPS on Tesla already. Chasey? Maybe a little bit. Yeah, gambler's fallacy. There's something positive in my life when I feel anxious for the future. Big sad day, sad recently, trying to risk down to build port. Still enter stuff too early. Cheapest way to get live ES. Also, like the stream, everyone. Isn't TradingView pretty cheap for live data on like SPX and futures? TOS is free, yeah. Well, not free. You have to fund an account, but I don't think it's $60 a year. It's like $2. You can use IBKR, but I mean, any broker you use, you're gonna have to fund an account. I pay $7 a month for TradingView futures and VIX. There you go. That's free. You just need $1. Okay. I remember TOS used to not let you paper trade unless you put like, was it like 250 or 300 in or something like that. Whoa, long sleeve shirt today. Is it cold or something? No, it was just on top of my laundry pile. Any more data or big things coming today? Yeah, we have an auction coming in at 1 o'clock on the 30-year, and we have Powell's speech at 2. How low can Fubo go? It depends on market conditions. Generally speaking, I would say it'll stay probably above $2. Um, even with like aggressive shorting, but like 220. But if there was a adverse market event, it could go much lower. You're a clean laundry pile kind of guy, or a clean laundry chair basket kind of guy. I'm really fastidious about folding all of my laundry as soon as it's done and putting it away. Oh, fuck off, bulls. Damn, there's still a lot of demand on this contract. I'm gonna pull back a little bit. The fact that I didn't get stopped out there is fucking ridiculous. Did you guys see that? JPow's at 2. Hmm. Are you stuffing the bid? No. I don't think we should have any reason to suspect that the 30-year would be anything other than close to spot. It's up quite a bit today. If it printed a fat tail, that'd be bearish as fuck. How cool would it be if JPAD just said we're fucked? Look at that. Nice. Fuck you, bulls. Get wrecked. A little close. Yes. Not a lot of put buying, but there's some profit taking on the call side. So I think they're closing 85s a bit for tomorrow. My brothers are in town from Oregon or in Tennessee, and they don't know to call their nieces Gherk yet. How best do I explain? Well, first start off with I've joined a cult, and then I feel like the rest should come pretty easy from there. Is QQQ just gonna rip its mask off like in Scooby Doo and reveal itself as Nvidia? The thing's a fortress. I mean, Nvidia hasn't broken 480 yet, right? Not really. It's amazing when a customer asks for assistance with a competitor product and we have to play dumb. Wait, why do you have to play dumb? Like, what do you do? Have you ever tried just servicing the competing product to see if you can? Greg, the other night a friend asked me if a hot dog was a sandwich. Fuck! God damn it. Oh, okay, that was a good fill. But still. Fuck. Jesus Christ, I've made 4 trades on this account today and it's flat. Uh, You're fired. Thanks. It still doesn't look fucking bullish, though. Fighting every fucking every like cent of downside. It's ridiculous. All right. Let's see. Just fucking flat. You know what? $72. That's awesome, right? What if I sell the 80? Ooh. 72.87. I got an entry closer to 80. Hmm. That's a pretty good fucking return. That stopped out of my membership chat. I'm sorry. I was able to save the day and refer him to the cube rule of food. Thanks for all the education, man. No problem, Pog. I'm sorry, dude. We're gonna close the day at like -4 cents just so the green streak is snapped and we can get another 8 days of green. Possibly. I'm starting to think we're gonna close the day at like 85. Which means maybe this isn't the best condor to build. Maybe I should build this one. Ooh. Yeah. I don't like that. Hmm. Realized vol is still fucked. Yeah, we'll see if it fills. Hashtag King of the Butterflies. Have you started loading up on longer dated puts yet? A little bit. I've been buying some like March AM like Vega plays. I think Vol's kind of bottomed out here at 1450, but I don't want to overextend in case they drive volatility lower, squeezing out the upside again, right? So, I'd almost be more confident adding Vega after a move down. It was really easy to add Vega back in like mid-October because we stayed below delta neutral. Can you remove that wedge from your screen? It doesn't confirm my biases. If it breaks down, that's really bearish, right? Descending head and shoulders. Ah, fucking Christ. Wait, did that fill? No, okay. Why didn't that fill? Oh, piece of shit. Mm. Yeah. Can you change your lower line to the dashed ones so the price can get through? You want me to perforate it? feel like VIX is turning up, and I probably shouldn't sell a butterfly here, but I really want to. They're really fighting to hold on. Yeah, they're not fucking around. Is this still profitable at 85 now? Gross. No, 85 is perfect. Maybe that's the one I should be going for. Maybe for 75. Fuck that. Still more puts being bought here. Yeah, I don't know. This might fail. The breakout here is really not getting a lot of momentum. But they keep stabilizing everything. Like, they just, like, step in and stabilize the sell-offs. You think Google started? What is with you and trading Google? It's still very much in a giant bear flag. So maybe wait till it breaks down below the bear flag? That might be like a good entry. Something like that. So maybe sub 130. The dip buy is relentless. It's unfortunately it's not that bullish. How do you feel about scalp trading Tesla on a regular basis? I don't like it. It's pretty volatile. I don't like it. It has, it can have a really hard time maintaining trends. They also reverse quickly, so yeah, it's not my favorite for scalping. I definitely want to use something more liquid and stable, like SPX or NQ. It's liquid. It tends to, yeah, it's usually, I mean, once it picks up momentum, it's pretty hard for NQ to stop. Like it generally doesn't reverse rapidly unless there's like really bad news or something. But a lot of people are really afraid of trading NQ, but I like it. It's not. I don't think it's as bad as Rut. Rut's worse. I'm gonna take a shower, wash the filth off this market. You don't like our $3 trading range, man? How dare you? I hate the Rut MM. Yeah. I love trading NQ. It's like ES on steroids. It's actually really good for scalping. Its breakouts are generally very strong and easy to exit. They pick up liquidity really fast, and you can get out quick. You don't want to trade. You don't want to trade chop on NQ. You don't want to get caught trading chop on it, right? That's kind of the problem. You definitely want trending days, but playing at level by level on a trend day, very profitable. Why won't they sell me my butterfly? Am I gonna have to wait for like the put spread to move? Maybe just do a put butterfly. Would that be better? Short put, long put. Almost like the range on that better. Hmm. same. There's no skew. Alright. Well, Gork, you broke it. No, I didn't. I did not. My 401k provider announced no more quarterly paper statements. Recession confirmed. I've been scalping QQQ. I just wonder if there's something better. QQQ's okay. Wait, what was that fucking notification? I don't even know what that was. Oh, I'm not paying $250 for it. You can fuck right off. You think we could drop to a new range with the auction and JPOW, or is 85 our range? Possibly. I don't know. I'm not gonna get filled on this fucking butterfly anyway, so I might as well just wait till afterwards. I'm gonna chase the bid around all day. There's a lot of fucking call selling right now. And I can't tell if it's just like the in the money calls or if it's just out of the money calls, but there's a shitload of it. The volume on both is pretty even right now, unfortunately. Tomorrow's expiration still kind of stacked at 85, but 90, 95, like that transition range I talked about last night, it still sucks. Yeah, I know. 5 minutes till the auction. Fed's pace. Expect high rates to be in place for a while. I'm not sure that public expectations are aligned with likely Fed policy path. Oof. Oh wait, when's I gotta find Powell's speech. Oh man, who the fuck is this guy? The interim St. Louis Fed chief? What a weird last name. I don't even know how to pronounce that. Pesa? Kathleen O'Neill. Pace? I don't know. I wish you were a cat too, Squamps. I'd give you snacks. Well, she had a whole bunch to say. It's too soon to declare victory on inflation. The central bank is still working to achieve policy price stability. Central bank has time to decide the next step on monetary policy. Path back to 2% inflation is going to be bumpy. I'm watching the 10-year for signals on financial conditions. Soft landing for the economy remains possible. U.S. central bank is restrictive, imparting modest downward pressure on inflation. I support a rate pause, but we may need to tighten further. It's unclear yet whether tighter financial conditions will provide needed restraint. I worry about just really fucking leaning into our role as temporary president. I worry about hidden leverage outside of the banking sector. I don't know if we're at the right level on rates. Inflation will be more stubborn than recent data suggests. We will not tolerate attack. Oh, that's the White House. Hold on. I'm not sure if public expectations are aligned with likely Fed policy path, and I expect high rates to be in place for a while. Fuck. It's pronounced Pachea? No, it's not. It's not Latino. Her name's Kathleen O'Neill. She's a blonde white lady. Maybe she's Venezuelan. There's still no fucking Latino representation on the Fed. Does anyone give a shit what she says, though? I mean, but she's saying a lot, right? Let's see. She started talking at noon and then went off for about 50 minutes. So maybe some people gave a shit what she said. She started talking like right here. Oh no. What's happened? Somebody fucking... I think my cat got my office last night. I came in here, there was all kinds of like weird shit typed on my keyboard. So she started talking like right there. She prints my puts. She can be whatever she wants. Exactly. She find out about your secret hidden leverage? What do? I don't know. Figure it out. I got a lot of Latino representation on my port with all these putas. Your cat's pretty cool. Had a whole conversation. 76543. So that was me. I also sent a cryptic message to PP. Pickles Picks? Oh, yeah. Yeah, he fucking like typed shit on my keyboard. Did the cat make any good trades in futures? Could be up. I don't think I have my futures account open. Fortunately, he doesn't know my password. Auction time. Yeah, let's go. I have no positions. Somebody's loading up on 380 puts here. Which one of you is it? Ugh. Is there any chance liquidity situation is worse because so many participants are sick of the manipulation? I don't think any market, like professional market participants, think the way you do. They don't care. Most of them are just trading like a net edge. Oof. Fuck. I guess I should have kept those 480. So which one of you did buy the 4380 put? 4.769? That's a fat tail. All right. I'm going to chase this. Ugh. How much settled cash do I have? Holy shit. Definitely should have held those. All right. Well, that's gamma neutral gone. Guess it's time to burn a day trade. Well, the 30-year is now immediately up 400 basis points. The 30-year printed with a big fat tail. Okay, they got gamma neutral back. Profit taking. Yes, like headed to test yesterday's low. That was fun. I'm not sure the momentum on this is dead yet. There's very little support down here. Hmm. Mm. Losing their grip a little bit. I mean, I think 4,300's probably excessive. But we're coming up to test GN now. Gamma neutral is like right here, by the way. 43.67. I think specifically it's 43.67.66. Hmm. Sorry. They're selling puts pretty hard. Shit. All right. Well. Yep. Fucking bastards. I'm gonna V this to the stratosphere. You mean back to like 75 or 80? Nope. Nope. Just back to 75. There is no more 80. 80's gone. Adopted by Dan's. Thank you so much, man. Guys, welcome to Cornishon. Give Adopted a shout out for hooking you up. Just when my account was about to be blown up, $350 left. I buy a put 3 seconds before a dump for 4x. You ain't getting rid of me yet, Kirk. Nice, man. Well done. This could still reject, yeah. There's no, like, all the call side interest has gotten blown up. I really didn't want to get stopped out of my puts there. Kind of want to see how this is going to turn out. Is QQQ going to be on SSR? That seems excessive. It's down 10 basis points. If they V this, I swear to God. Well, if it's any consolation, all the calls just got blown up. Unfortunately, there wasn't a lot of put interest below 70, so... But that's kind of accumulating right now, which is neat. Why are bond yields exploding? The 30-year printed with a big fat fucking tail. Huge. The 30-year auction stop compares to 4.837% last month, a second reopening and the highest since 2007. The high yield of 4.769. Bid to cover 2.24. US sells 24 billion, awards 18% at the high bid. Primary dealers take 24.73, direct at 15.16, and indirect at 60.11. Prior to the auction, the yield was at 4.716. So, yeah. It's a big tail. Oh, and reverse repo is under $1 trillion. I really want us to break 43.50 and hit DN. That'd be awesome. That'll take Powell, though. Powell's going to have to be hawkish. You actually just saved my GGEM port today when today was becoming yet another slow bleed day before. I hope you know how much it means to us. Nice, man. Well done. I do. The print was bad. It was really bad. 4.1 versus 4.71 versus 4.76. Dixie's up 13 BPS. The US 30 is now at 4.801. 20 years back, almost back over 5%. Get a load of those bips. I didn't buy any put just then because I was just recovering my cost basis, which I'm very thankful for. Nice. Why is TLT big down? I thought that would be bullish for it. No, opposite. TLT is based off the price of the 20-year bond. Does that tell me nobody wanted the 30-year? E.g., yields had to go up to convince people to buy. Yeah, essentially. That's kind of what happens when you get a fat tail. Is that you know basically, well, let me try to put this more broadly. Basically, it's an indication that the market sentiment towards bonds is negative, right?
because there weren't buyers at a sufficiently at spot, right? So the yield had to increase to match demand. And it wasn't a very big auction. It was only, and it was a big spike in yields for a very small, like it was like a $24 billion auction, which is, you know, almost half of what they issued yesterday. So yields went up a lot in order to find demand for the 30-year, and that could be like, you know, an expectation of higher inflation or higher interest rates or um, um, a move away from fixed income assets, but that's probably not very likely. And consistently getting fat tails on yields over like a period of time, which we've been seeing, um, that generally causes more concern for like the financial health of the issuing government. Are you implying that bond buyers last week might not have just been normal longs? Yeah. Hello, could Tesla drop? I have stop set, but I was wondering if I should tighten them. Next resistance to the downside on Tesla is at like 207, which it tapped. So there could be some profit taking there. Bulls are still trying to stabilize this on SPX. There's still quite a lot of call selling going on. Yeah, I don't know if they're going to be able to hold it here much longer, but they have stability at 70, 75. There's a put and a call wall at those levels, so we probably stay here until JPOW. Which is going to be in 35 minutes. Jesus. And I've got that pulled up. I think there's it's pretty likely that there's commentary on monetary policy given that it's a policy panel discussion. Poll Doverhawk. Yeah, let's find out. Without a see like without too much Q&A, I feel like he'll end up veering towards hawkishness. So I think it'll depend on the amount of Q&A they do. I don't know if it matters what he says. The 30 years, that was a big deal. Man, they're really trying to stabilize bonds right now. It's Jacques Pollock annual research conference for the IMF. Hey all, I've been out for a few months. What did I miss? I'm not even gonna ask what you did to GME. I didn't do that. You missed the market drop a few months. You missed the market drop 10% and then bounce back 6%. It's been a wild ride. Tie color prediction. I just hope it's not fucking gray again. I can't deal with that twice. 58% of chat is in for a surprise when J-Pow repeats the exact same speech for the 80th time, answers the same questions, and still says they'll raise rates based on data. We'll still pump. We'll see. There's not a lot to pump into now. All the fucking calls got stopped out. Put weighted strangle for J-Pow. Um, at 43.70, that might not be the worst. Okay. I like where your head's at. Do we repeat October after the 30-year bond drop? In October, we dropped from the 30-year to Friday after Opex, 14 days ish. Maybe. All right, we got about 30 minutes. I'm gonna see if I can find something to eat real quick, and then I'll be back for the J-Pow speech. Clench your butt cheeks. What's the tail? It was like 0.58, I think. There's a report that an ICBC ransomware attack disrupted the US Treasury market. Yeah, 0.058 on the tail. How do I vote? Hawk or Dove? It's up to you. What do you think? I want to interfere in the elections? If this is the extent of the pullback, likely still ups next week. If this is all we get, I'd be surprised, frankly. Laces out, man. Fucking A. Nice, dude. Frantically searching around for tinfoil. Financial Times blaming Treasury dump on malware attacks. China's ICBC for real? That's the report. Says that China's largest bank had been hit by ransomware software, disrupting the US Treasury market. Which is obviously bullshit, but interesting. 0.058 is a big tail, right? Yeah, that's a really big tail. The 10-year tail yesterday was 0.008. Yep. Is it vary depending on duration? No, that's a huge fat tail. I think it's the largest since 2004 or something, they said. Hold on. 2007. Is this like actual shilling? It's really happening for real? Wait, where? No, tail, not Captain Jack Sparrow. Although I love that song. A tail is when the yield on a bill or bond comes in above spot. So the issuing government needs to raise the yield in order to meet demand and issue their debt. We back on furries again in here? No, I don't think so. Well, maybe. The fuck is a furry? It's like people who dress up in animal costumes and have sex with each other. Tail is like price improvement for yields. Yeah, but yields are inverse the price of bonds. It's more telling about the lack of demand than an increase in demand. Be honest, have you dressed up as a duck? Never. Trash would get really mad if I did that. Does the Treasury have to pay the yields? Well, they're not paying a yield. They're raising the yield to meet demand from the market. They could, or they could just not issue securities because the yield is too high. How can we convince you to dress like a duck? Not gonna happen. You said mad, but I'm pretty sure you meant turned on. No. Don't patronize me. I wasn't patronizing you. You'd know if I was patronizing you, Brett. Well, if they stop issuing debt, then the government stops functioning. I kind of patronized Jason Bowers, but that's because he used price improvement as a description of why tails. I didn't like it. I didn't mean to, but I might have come off a little patronizing there. If I buy Pontiff, will you try to steal a deck from Central Park with me? Yeah, fuck yeah. I'm down. It's not that hard. You just run in and grab one. What were you for Halloween? Nothing. Wasn't feeling too good, so I just stayed home. I gave out full size candy bars because I too am a pigeon whale. Tailspin was a great show. It really was. Can we get a Discord channel to suggest people on Twitter you should have an argument with? I think that would be fun as fuck. It's so draining though. How are you not a pontiff? I'm not gonna pay that much money to hang out with myself. The question is, will you dress up like a duck? I will not. It wasn't Charleston Chews. That was last year. You know that Tailspin and DuckTales are in different universes, although Launchpad McQuack appears in both. No. So What does that tell us about Launchpad McQuack? Darkwing Duck was pretty great too. Is Pontiff a tax write-off? That's between you and your accountant. If I get Pontiff, I'm buying 2 duck onesies. All right. That's a weird outfit to get drunk in, but sure. Not enough people talk about the DuckTales theme song. Oh, there's a really great version of that. Life is like a hurricane here in Duckburg. Just FYI, CNBC has a live feed of JPOW on YouTube that's about to start in 2 minutes. I have a live feed directly from the conference that's about to start in 2 minutes. Uh, let's see. So decent pile of put interest at 43.50. Options interest overall is kind of flattening out right now. VIX is up. I'll switch the bottom pane to VIX over here. I'll zoom out a little on SPX. Oh shit. Yeah. Now my fucking food's done. I don't care. Wow. So if your 4350 goes in the money, I quit my job and come work for you. Don't do that. I'm not hiring. This is gonna be a rough day. What's more important than going in the money is that I take profits on it after it goes in the money and I don't get stopped out before then, right? Did you dare find support at 55? What a stupid arbitrary level. You bitch. All right. I'll be right back.
So I'm going to introduce them briefly in the order in which they will speak. We'll start first with Jay Powell. We're very fortunate to have Jay with us. Jay is chairman of the Federal Reserve System since 2018. Arguably, many would say, the most powerful policymaker in the world. He served as a member of the Board of Governors since 2012. Prior to the Federal Reserve Board, Jay worked in investment banking. He also served as Undersecretary of Treasury for Domestic Finance in George W. Bush, Bush administration. Amir Yaron has been governor of the Bank of Israel since 2018. That is for almost as long as Jay's tenure as chairman of the Fed. Before that, Amir was professor of banking and finance at the Wharton School of Business at the University of Pennsylvania. And he's a world-renowned expert in macroeconomics, monetary economics, finance, and financial economics. And we're particularly delighted to have Amir with us today. Geeta Gopinath requires no introductions, I think, especially in these walls. But she is the first deputy managing director of the International Monetary Fund. Previously, Geeta had my job as chief economist and head of the research department. And prior to joining the IMF, she was the John Swanstra Professor of International Studies and of Economics at Harvard Universities with a world-class record of research on exchange rates, trade, and investment, international financial crisis, monetary policy, debt, emerging market crisis, a very, very long and distinguished list. And then last but obviously not least, Ken Rogoff. Ken is the motivation for this year's annual research conference in his honor. And we're very happy to have him today and tomorrow. And currently, the Moritz Boas Professor at Harvard University, also a former chief economist at the IMF in 2001, 2003. Another turbulent time for the global economy. Ken has written several extremely influential books and, of course, many, many research articles on debt and financial crisis. He has written what remains to this day a reference textbook graduate textbook in international macroeconomics with Ken Rogoff in 1996. Is known for, with Maury Upsfeld in 1996, is known for his pioneering work on exchange rates, central bank independence, sovereign debt, financial crisis, among many other topics. And Ken has long ranked among the most cited economists. I checked quickly, and I think his REPEC ranking, which is something us for academics or former academics, we check carefully very often. I think his REPEC ranking is number 11, which is totally astonishing. And his Google Scholar count is, you know, off the charts, astronomical. And for those of you who don't know, I have to all mention this, Ken is also an international chess grandmaster. Now, we will start with short interventions from each of the panelists for about 10, 12 minutes, followed by a quick discussion between them, and then we will open for discussion with the audience. There are mics in the aisles. If you are at the point at which we reached that stage in the panel, if you want to ask a question, please line up behind the mics, and then you will have a chance to do that. I will only ask that, since our time is counted, that you keep your questions brief, and you also keep them focused on the topic of the panel, which is monetary policy challenges for the global economy. Now with this, let's start with Jay. I believe Jay will talk about the nature of the inflation process in the US and the appropriateness of the monetary policy response. It's up to you, Jay.
Thank you very much, Pierre-Olivier. It's great to be here, particularly in honor of Ken, whom we're proud to count as a member of the Fed family. So my assigned topic is U.S. monetary policy in the current global inflation episode. So I'll begin by briefly addressing the U.S. outlook, and then I'll turn to three broader questions raised by the historic events of the pandemic era. So to begin, U.S. inflation has come down over the past year, but remains well above our 2% target. My colleagues and I are, of course, gratified by this progress, but we expect that the process of getting inflation sustainably down to 2% has a long way to go. The labor market remains tight, although improvements in labor supply and a gradual easing in demand continue to move it into better balance. GDP growth in the third quarter was quite strong, but like most forecasters, we expect growth to moderate in coming quarters. Of course.
Powell, by refusing to treat climate change like a systemic risk,
thank you.
You are putting us at
Thank you very much.
economic disaster.
Thank you very much.
Climate change
Yep.
will end in
Thank you. Just close the fucking door. Close the door.
Did I miss the whole fucking thing?
Little interlude.
Okay.
Of course, climate issues are important, and they're appropriately addressed. But as I mentioned, we'll try to keep the questions on the topic for today. Okay. So, monetary policy challenges for the global economy. Thank you.
No way J-Pow dropped the F-bomb.
Yeah. No, I don't. Hold on. Let me check. We might have to go too.
Really? Were there more climate protesters again? Is there like a group of roving climate protesters that are just chasing J-Pow around? It was the host? Oh.
Not at all. No, don't worry about it. Okay, where was I? Inflation was coming down. The labor market remains tight, although improvements in labor supply and a gradual easing in demand continue to move it into better balance. GDP growth in the third quarter was quite strong, but like most forecasters, we do expect growth to moderate in coming quarters. Of course, that remains to be seen, and we are attentive to the risk that stronger growth could undermine further progress in restoring balance to the labor market and in bringing inflation down, which could warrant a response from monetary policy. The FOMC is committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. We are not confident that we've achieved such a stance. We know that ongoing progress toward our 2% goal is not assured. Inflation has given us a few head fakes along the way. If it becomes appropriate to tighten policy further, we will not hesitate to do so. We will continue to move carefully, however, allowing us to address both the risk of being misled by a few good months of data and the risk of over-tightening. We're making decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity, inflation as well as the balance of risks, as we determine the extent of additional policy firming that may be appropriate to return inflation to 2% over time. And we'll keep at it until the job is done. So with that, let me turn to the three questions that I've posed that have arisen from the receding but still elevated inflation we're experiencing today. The first question is, with the benefit of 2.5 years to look back, what we can say about the initial causes and ongoing policy implications of the current inflation. After running below our 2% target over the first year of the pandemic, core PCE inflation rose sharply in March 21. Economic forecasters generally did not see this coming, as shown by the February 21 survey of professional forecasters, which showed core PCE running at or below target over the subsequent 3 years. So the real-time policy questions for policymakers were what caused the high inflation and how policy should react. And at the outset, many forecasters and analysts, including FOMC participants, viewed the sudden upturn in inflation as mostly a function of pandemic-related shifts in the composition of demand, a disruption of supply chains, and a sharp decline in labor supply. The resulting supply and demand imbalances led to large increases in the prices of a range of items most directly affected by the pandemic, especially goods. In this view, as the pandemic abated, our dynamic and flexible economy was likely to adapt fairly quickly. Supply disruptions and shortages would diminish, labor supply would rebound, aided by the arrival of vaccines and the reopening of schools. Elevated demand for goods would shift back to services. Inflation would ease reasonably quickly without the need for significant policy response. Indeed, although monthly core PCE inflation spiked in March and April of 21, beginning in May, it declined for 5 consecutive months, providing some support for this view. But, of course, in the fourth quarter of 21, the data clearly changed amid waves of new COVID-19 variants, with only gradual progress in restoring global supply chains and relatively few workers rejoining the labor force. That lack of progress, combined with very strong demand from households, contributed to a tight economy and a historically tight labor market and more persistent high inflation. The committee signaled a change in our policy approach and financial conditions began to tighten. Of course, a new shock arrived in February of 22 when Russia invaded Ukraine, driving up prices of energy and other commodity prices. By the time we lifted off in March, it was clear that bringing down inflation would depend both on the unwinding of the unprecedented pandemic-related demand and supply distortions and on our tightening of monetary policy, which would slow the growth of aggregate demand, allow supply time to catch up. Today, these two processes are working together to bring inflation down. The FOMC has raised the federal funds rate target by 5.25 percentage points, and we've reduced our securities holdings by more than $1 trillion. Monetary policy is in restrictive territory and putting downward pressure on demand and inflation. The unwinding of pandemic-related supply and demand distortions is playing an important role in the decline in inflation. For example, wage growth has steadily fallen since mid-2022 by most measures, despite continued robust job gains, reflecting a resurgence in labor supply, thanks both to higher labor force participation and a return
If they try to hold a
immigration
level,
to
they're going to try to
pre-pandemic
hold
levels.
50.
While the broader supply recovery continues, it's not clear how much more will be achieved by additional supply-side improvements. Going forward, it may be that a greater share of the progress in reducing inflation will have to come from tight monetary policy, restraining the growth of aggregate demand. Turning then to my second question. For many years, it has generally been thought that monetary policy should limit its response to or look through supply shocks to the extent that they are expected to be temporary and idiosyncratic. Many argue as well that in the future, supply disruptions are likely to be more frequent or more persistent than in the decades just before the pandemic. A second question then is what we've learned about this standard looking through approach. The idea that the response to the inflationary effects of supply shocks should be attenuated arises in part from the trade-off presented by those shocks. Supply shocks tend to move prices and employment in opposite directions, whereas monetary policy pushes each in the same direction. Therefore, the response of monetary policy to higher prices stemming from an adverse supply shock should be attenuated because it would otherwise amplify the unwanted decline in employment. In addition, supply shocks have most frequently come from the volatile food and energy categories, and they've passed through quickly. While food and energy prices critically affect the budgets of households and businesses, the policy tools of central banks work more slowly than commodity markets move. So responding aggressively to quickly passing price increases could exacerbate macroeconomic volatility without supporting price stability. Our experience since 2020 highlights some limits of this thinking. To begin with, it can be challenging to disentangle supply shocks from demand shocks in real time, and also to determine how long either will persist, particularly in the extraordinary circumstances of the past 3 years. Supply shocks that have a persistent effect on potential output could call for restrictive policy to better align aggregate demand with the suppressed level of aggregate supply. The sequence of shocks to global supply chains experienced from 2020 to 22 suppressed output for a considerable time and actually may have persistently altered global supply dynamics. Such a sequence calls on policymakers to use policy restraint to limit inflationary effects. Policy restraint in this case is also good risk management. Supply shocks that drive inflation high enough for long enough can affect the longer-term inflation expectations of households and businesses. Monetary policy must forthrightly address any risks of a potential de-anchoring of inflation expectations, as well-anchored expectations help bring inflation back to our target. The sharp policy tightening during 2022 likely contributed to keeping inflation expectations well anchored. My third question, then, is the level where interest rates will settle once the effects of the pandemic are truly behind us. By 2019, the general level of nominal interest rates had declined steadily over several decades. As the pandemic arrived, many advanced economies had below target inflation and low or mildly negative rates, raising difficult questions about the efficacy of interest rate policy when constrained by the effective lower bound, or the ELB, as we call it. Over 2 decades, an extensive literature had identified a number of possible changes to the widely used inflation targeting regime, including negative policy rates, nominal income targeting, and various forms of makeup strategies, under which persistent shortfalls in inflation would be followed by a period of inflation running moderately above 2%. Today, inflation and policy rates are elevated, and the effective lower bound is not currently relevant for our policy decisions. But it's far too soon to say whether the monetary policy challenges of the ELB will ultimately turn out to be a thing of the past. The prolonged proximity of interest rates to the ELB was at the heart of the monetary policy review and the changes we made to our framework in 2020. We will begin our next 5-year review in the latter half of 2024 and announce the results about a year later. Among the questions we will consider is the degree to which the structural features of the economy that led to low interest rates in the pre-pandemic period will persist. With time, we will continue to learn from the experience of the past few years and what implications it may hold for monetary policy. These are just 3 of the many questions raised by these challenging times, and of course, we're very far from a complete understanding of the answers. Again, it's great to be here today, and I look forward to our conversation. Thank you.
Thank you. Thank you very much, Jay, and I think we're really off to an excellent start with your remarks. Let me now turn to Amir. Amir, Israel is a small open economy, faces very specific challenges. Like the US and many other countries, it's seen an increase in inflation in recent years, and the Bank of Israel has been acting on it. In addition, like other small open economies, it faces potential spillovers from monetary policy decisions taken elsewhere by major central banks, with a potential impact on currency and capital flows, and we'd love to hear your views. So, Amir, floor is yours.
All right. First, it's a pleasure to be here in a conference in honor of Ken Rogoff. We all cherish and follow his distinguished contribution in academia and practice. Sort of in a sharp turn, as we're all aware, Israel is currently at a war following the October 7th inhuman brutal attack by the terrorist organization of Hamas. This is a crucial time for Israel's security, and we thank all those who support us. Our hearts are with the innocent victims of the war, and our hope is for it to end with a safe return of hostages and with peace and security. And now I'm going to turn now. I want to turn now to address the issues and questions presented for this session. An important question is, to what extent can a small open economy like Israel, or for that matter, any SOE, conduct its monetary policy independently, or should it rather follow the steps of the major economies? Another question is, what are the spillovers from the policy taken by the major economies to small open economies, and how do those impact local
He was pretty
conditions?
by the book.
The answer to these questions
So decently
depends
hawkish.
on the development of the economy, its specific areas of exposure to the global economy, and the particular shock it might need to react to. Generally, local monetary policy cannot be entirely disconnected from that in the major economies. Yet, local circumstances justify and require setting policy that is tailored in accordance with the economy's structure and needs. Key considerations will include interest differentials, foreign exchange and the effect on domestic activity, in particular exports, and on inflation and on financial markets. As we all know, our planet has become a
Yeah, they're
small
just
village.
defending it.
The COVID experience demonstrated the spillovers that can result from a common shock. Monetary policy was generally similar in many countries because the initial health shocks, as well as many supply-side difficulties, were similar. Also, we benefited to some extent from the common monetary framework, such as inflation targeting. And that meant that monetary policy in different economies was predicted to act in a similar manner. Having said that, the differential health shock and related steps, fiscal policy differences, and exposure to supply side effects and commodity prices led to somewhat different policies, consequent inflation, and activity outcomes. Consequently, there was more heterogeneity in monetary policy exiting
absolutely.
COVID than upon its entry. Israel was fortunate in that sense, with relatively small share of tourism sector and a relatively large high-tech sector, which actually benefited from the increased dependency on remote work. These circumstances led to a wedge between global monetary policy and the required domestic monetary policy. This slide shows that for these reasons and others, inflation in Israel is in the lowest quartile of rates in the OECD. In particular, headline inflation in Israel was low because its natural gas supply and prices were shielded from global developments. The next slide shows the swift recovery of the Israeli economy from the COVID crisis. The level of GDP exceeded its long-run trend already by the end of 21 and stayed somewhat above this trend by Q3 23. And we'll come back to this recovery ability of the Israeli economy. An additional key attribute in Israel that affects potency and effectiveness of monetary policy is the large share of mortgages that are directly tied to the Bank of Israel.
I think the profit taking's kind of burned out.
Therefore, raising rates influences the stock of almost all homeowners.
So we'll see what happens here
not just
above
new ones.
42.55.
This is another cause for possible differences between global and local monetary policy decisions. The Bank of Israel was one of the first central banks to respond to the increase in inflation. As a first step, we shrank the unconventional tools employed during COVID, that is QE, FX intervention, and special funding to commercial banks. Relative to its rate of inflation, Israel has been among the first movers. This is another evidence for only partial dependence of SOE on policy taken by major central banks. Here you could see the relative time it took to get into a restrictive zone. The policy the Bank of Israel has in fact set in recent years is consistent with this approach. We are aware of the fact that domestic monetary policy cannot deviate too much from global conditions, but at the same time, we recognize that policy should be set according to specific shocks to our economy, taking into account its fundamental attributes. And you could see over some cycles are shared and some are not. Let me show you some specific shocks. We learned over the years that there is a strong connection between the S&P and NASDAQ indices and the shekel dollar exchange rate. This is because Israeli institutional investors react continuously to changes in the value of their foreign denominated portfolio. This slide shows this pattern very clearly. The orange tracks the blue. However, as can easily be seen, since the beginning of 23, this strong connection has weakened. This was the time period that potential changes to the judicial system ignited a widespread civilian opposition. Similarly, the Israeli and US stock markets, who tend to move together, also displayed a weakened connection. According to the assessment done at the bank, if the exchange rate were to follow the NASDAQ the pattern with the NASDAQ index, according to the previous periods, the shekel would have been about 15% stronger relative to the actual foreign exchange rate in September 23. You see it in the gap at the end. Given our estimates of the foreign exchange pass-through to inflation, this amounts to about 1 to 1.5% additional inflation. This demonstrates, again, the power of local significant developments that might have on financial markets, on inflation, and therefore on policy. I want now to move and discuss current developments in relation to monetary policy. An important part in the analysis is, of course, the initial conditions. The Israeli economy is strong and stable. It has robust and healthy economic foundations. We are a global leader in innovation and technology. The Israeli economy has known how to function and to recover from difficult periods in the past. and to return to prosperity rapidly.
This guy
I have
trying to
no doubt
sell
that
the
same
Israeli
will be the case
economy?
this time. You could see the growth rate after different military
Why is
events.
this so positive?
Importantly, over the years, Israel has shown responsible fiscal position as demonstrated by the declining path of the debt to GDP ratio. Israel entered the war with a very solid fiscal stand. Our debt to GDP ratio is just under 60% and a budget deficit which was expected to be 1.5% in 23 following a surplus in 22. There is no doubt
It's an
the war
IMF
will have
meeting.
fiscal implications and generate budget pressures. According to initial projections of our research department, which of course, and I cannot emphasize this enough, are accompanied by extreme uncertainty. And assuming the war is primarily concentrated in the southern border and lasts till the end of this year, GDP growth is likely to shrink by about 1% in 23 and 24, and the debt to GDP ratio is likely to rise to somewhat more than 65% by the end of 24, as costs are larger than it was initially projected. As I mentioned in my opening, Israel has been in a war for a month now. Above and beyond the vast human, security, and political consequences, there is no doubt this is a major shock to the economy, to households, workers, and businesses. Economic policy, fiscal, and monetary, which we in the BOI lead, takes the necessary actions in order to alleviate the difficulties accompanying these challenging times. With the outbreak of fighting, significant depreciation pressures were seen, which were reflected in early trading in foreign markets. The Bank of Israel responded rapidly. Already on October 9th, before trading opened, we implemented a plan to sell up to $30 billion of reserves and to put into operation swap transactions totaling up to $15 billion. Within the framework of the program, the bank is acting in the market to moderate the fluctuations in the value of the shekel and to supply the liquidity required to continue the orderly activity of the markets. The initial high level of the Bank of Israel's foreign exchange reserves at about $200 billion, 40% of GDP, gives us ample space to act to achieve this target. In addition, the bank also put into operation a shekel repo transaction plan and a monetary program focused on small businesses. In parallel, and that's the other side to the approach, from the beginning of the war, the Bank of Israel rapidly formulated a uniform and agreed upon framework that was adopted by the commercial banks and was expanded to credit card companies as well. The framework is focused on those serving in the Army reserves, the population on the borders, and the families of the victims and hostages. These populations will be able to defer for 3 months payments
that's
on
what their
mortgages,
currency's
consumer
called.
credit, and small business credit without cost. Many of the banks have extended these steps, a very welcomed outcome, as they are stable, resilient, and have ample capital buffers. In our interest rate meeting on October 23rd, we kept the policy rate at 4.75. This is consistent with the bank foreign exchange activities and inflation endeavors. This array of policy steps that were taken by the bank in the last month reveals the sufficient and necessary independence that the bank enjoys and that it has the adequate set of monetary tools that can ensure financial stability. Avoiding a reduction in the rates is in line with operating in the FX market to moderate large depreciation fluctuations. Moreover, the steps taken by the bank vis-à-vis the banking sector allow in practice some monetary easing, but targeted at those who need it most, without compromising the need to deal with increased risk premia in financial market. Let me say, 1 month in, we can cautiously say that the policy mix we applied contributed to the stability not only of the FX market, but also had positive spillovers for the stability of local financial markets. The developments in the markets also indicate that the public understands that the BOI enjoys the required independence in order to take the necessary steps at these times. Inflation expectations, as you can see in the slides, for the short term and the long terms have remained substantially stable and are stating that we will be back in the inflation target. The exchange rate has depreciated a lot, but by now is back to the level prior to the war. Let me, so you could see the red line, this depreciated more than previous military events, but it's now back to where it was. Fiscal, let me finish here. Fiscal policy is, of course, central and crucial for the ability of the economy to overcome this crisis and to resume growth in the medium and long term. The government is working on various fiscal support plans, which the bank is playing a key role in advising in its role as economic advisor to the government. The bank has stated the importance of finding a responsible balance between supporting the economy and maintaining a sound fiscal position. While it is clear that overall fiscal needs will increase, the bank advice is and was to utilize the 23 budget, yet demonstrate fiscal responsibility by introducing several important adjustments and cuts in less necessary activities in 23 and 24 budgets. I'll finish here. I have no doubt that, as always, Israel will prevail and has the right ingredients to spring back to its great economic potential. We all hope for calmer and more tranquil times. Thank you.
Thank you. Thank you very much, Amir. We will now move to Gita. Now, of course, in light of what both Jay and Amir have told us, I think the question in front of us at the front is, how to think about the challenges for central banks and whether central banks have the appropriate toolkit at the current juncture. And I think everyone will be very grateful
dollar
to hear
moon,
those.
because rates rocketed.
Thank you so much. And firstly, as a former student and colleague of Ken, I'm really glad that we're able to honor Ken Rogoff's tremendous contributions to academia and to the policy world through this conference. So as Pierre Olivier said, what I'm going to talk about is some of the challenges that monetary policy making faces in this current inflation environment. I think it's fair to say that we are living through a period
If we
of
lose 43.50, we're probably going to go
uncertainty.
to delta neutral.
We know that there are multiple shocks that the world has faced, and unprecedented shocks, the pandemic, wars, conflicts. The uncertainty that I want to emphasize, though, here is about how the current episode of monetary policy tightening has not been your typical monetary policy tightening
43.34, I believe.
and that generates its own source of uncertainty about how to go ahead. So what exactly do I mean by that? So yes, we have had
61.
inflation go up quite dramatically in many parts of the world.
Delta neutral may not be a
And
resistance,
central banks
though.
have appropriately raised interest rates
Also,
quite
there's a
sizably
fat fucking
in
gap
this
from
last
like
year and a half, couple of years.
43.46
And we've seen
down
inflation
to
decline. All of this
43.20.
is standard. But if you look under the hood, I think what is highly atypical is that this decline in inflation has not come along with a rising rate of unemployment, a significantly increase in the unemployment rate, or a significant slack in the labor market. This is atypical because usually the way we think of policy affecting inflation is to reducing aggregate demand, and then that shows up in the labor market through higher unemployment. Now, this is true if you look at the US, you look at the euro area, UK, but also several emerging markets, including Mexico, if you look at emerging Europe, and several others. So what has helped? How have we gotten a bunch of this inflation decline? Much of the work has been done by improved supply. And here I'm talking about the decline in energy prices and food prices that have helped bring down headline inflation. The improvement in global supply chains have helped bring down core goods inflation. The business that's still left is when you look at services inflation, where variables like wage growth play a very important role. And core services inflation, or more services inflation more generally, remains elevated. So in that sense, the job is not done. But this can be tricky in terms of communication, because on one hand, you see inflation all headed in the right direction. But on the other hand, you realize that this last mile will likely be the toughest. So if you look at measures of core services of inflation, let me just give you a couple of numbers. The US is now at 5%. The euro area is at 4.5%. These numbers are well above central bank targets. Okay, so what does that mean in terms of policy going forward? The first point that I'm going to make is that that means that it's important to avoid premature easing of monetary policy, either through action or through words. Now, this is going to be a challenge because we are living in a difficult period in terms of reading the signals. We are going to see labor markets have greater slack. We are going to see unemployment rates go up. So that's going to be a difficult message to stand by and say that, well, we have to make sure that we get the job done. The other reason this is going to be a challenge is because we have lived through a period of inflation that's been high, and the persistence of inflation makes it more difficult to then see through supply shocks, something that Jay mentioned, which is that we still live in this environment where there are numerous potential shocks that can hit the world economy, including the terrible conflict that's in the Middle East that Amir talked about. If it were to spread into a more regional conflict, we could see a sharp increase in oil prices. That will then affect headline inflation numbers. And in an environment where inflation has been high for a while, that can dislodge short-term inflation expectations. And our research has shown that it's very important what's happening with short-term inflation expectations. Because if you can keep that close to your target, then that makes the job of central bankers much easier in being able to bring down inflation while at the same time not needing a big loss in terms of output. So it improves the odds of a soft landing. The other challenge that comes up is what's happening with long-term rates. We've seen long-term rates in the US go up quite significantly in the last several weeks. It's bounced around a bit, but still these are much higher numbers than in the past. So this raises a question, which as a policymaker, does this mean that then you don't have to do the next interest rate hike, if that's what you were thinking about doing? Because now you're getting the effect that's working through higher long-term rates. And here again, this is tricky given the uncertainty. So let me just explain, which is it depends a whole lot on what's driving the higher long-term rates. If the higher long-term rates are being driven by expansionary fiscal policy, then in fact, a higher long-term rate should actually signal a need for even more monetary policy tightening to offset the expansionary effect that it's having on the economy. In the US, where you're seeing most of these interest rate increases, the US fiscal deficit is around 8% this year, and it's projected to be around 7% over the next 3 years. Now, there is a question mark of how stimulative that is.
I don't think this has a rewind function.
But when you have high levels of deficits, that certainly is something for a central banker to also incorporate when they're trying to make their forecasts about the path of inflation. My second point about what it means for policymaking in this environment is that central banks must be prepared to respond to renewed financial stresses, especially if inflationary pressures persist. So again, there is the last mile that has to be done, but if inflation remains far more stubborn or further it goes up in some more because of other shocks, then that will require interest rates to stay even higher for longer or even increase. And we could be then in a situation where you have an inflation problem while at the same time growth is slowing sharply. So that's a stagflationary environment that one could have, and one certainly should not rule that out. In that scenario,
Yeah, I'm not sure we're
again,
gonna
some of our
hold
research has shown that we would have a
43.50.
large number of weak banks that represent about 1/3 of global assets.
It's a nice
mostly
ramp
located
building up down to
in
delta neutral right
advanced
now.
economies and in China. That would be a very difficult place to be in, which is why it's important to prepare in advance. This is the time for strong supervision, robust stress tests, and it's also important for banks to be able to augment their capital buffers at a time when they're making currently very high profits. Banks should also be prepared to quickly access central bank facilities if needed, so that we don't have a repeat of an SVB phenomenon. And much more efforts need to be made to address the risks in the non-bank sector. The third point I'd like to make about policy in the current juncture is that policymakers have to be prepared for more cross-border pressures from increased divergence across economies, increased divergence in policies across economies. So let me give you an example. If you compare 10-year yields in China in its own currency to 10-year yields on US Treasuries, for the first time, the numbers have flipped around. So we actually have yields in China Treasuries, 10-year Treasuries are now around slightly less than about close to 2% lower than the yield that you can get on US Treasuries.
She's saying yield?
Now,
okay.
That obviously puts lots of pressure on exchange rates. And so I'm going to conclude with a few thoughts on what it means for a central banker, especially of a smaller open economy, that's facing pressure from weakening currencies in this environment where yields could look very different for a while.
No, it's not yields. She's saying
This is based,
yields.
by the way, on a lot of research that we've been doing at the fund. It's called the Integrated Policy
I
Framework.
like how they panned across the audience
Okay, so first,
like it's a
what does
Taylor
this mean
Swift concert.
for exchange rate interventions? I think the important thing for central bankers to keep in mind is first that the exchange rate movement is being driven a lot by fundamental shocks. So it is being driven to an important extent by interest rate differentials, which means that in such an environment, exchange rate flexibility has a very important role to play, and it helps you with adjusting.
Calm
But of
down,
course, on the other hand,
Shryma.
what can happen is in an environment of heightened uncertainty, you could see exchange rate movements entering zones that then pose a risk in terms of financial stability concerns, especially if you have shallow FX markets.
Recharge the
And there's also
eels.
this
Some of you
risk,
have been
which I
here
often
for too
fear,
long.
that you might have exchange rates going past some psychological thresholds, which then can lead to non-fundamental behavior in these markets. So in this environment, of course, in these specific cases, FX intervention can play a useful role. But this is going to require judgment, and this is the hard part, which is telling apart when is it truly fundamental and when is it non-fundamental for which intervention should happen. I think the basic policy has to be not that the only thing that matters is if you see a sharp movement in the exchange rate. A sharp movement of the exchange rate can truly reflect differences in fundamentals. But it has to be a sharp movement in exchange rate that then interacts with some friction in the economy. And you can see that through, say, deviations in uncovered interest parity or covered interest parity that then tells you that this shock is getting amplified through frictions, for which you certainly interventions can help. And the last bit on FX policy is just to remember that there is no free lunch. Countries have a certain amount of FX reserves. If you use it, deploy it at a time when it's not really needed and prematurely, then that, of course, means that you're going to have less to use when you are in a more difficult period. So with that, I have 30 seconds to conclude, and just to remind everybody in terms of the 3 points I made, which is firstly, the job of bringing down inflation is not done in many countries, and that requires that you to avoid premature easing of monetary policy, either through action or through how you communicate.
Why can't the IMF
Second,
just do
it's
its
important
job
to
and pin all the
central banks to be
currencies to
prepared
the dollar
respond
like
the new
they're
financial
supposed to?
stresses and also to buffer the financial system. And third, for policymakers to be prepared for more cross-border pressures because of increasing divergences in policy stances across economies. And I'm going to stop there. Thank you.
All of these small economies fighting back against our dollar dominance is irritating.
Thank you, Gita. And I will now turn to Ken. Now, of course, Ken, your own work, both when you were in policy, but as an academic, over many, many years, you've touched on all of these issues. And I think, as many people have mentioned already today, your
It's not Ken Griffin.
both sets of contributions, academic and policy, completely irrigate our own thinking on these matters. And so I think we're very eager to hear your views on all this.
Why did you buy TQQQ puts? Because I wanted them? Why not something
So
else
first I
like
wanna thank the
SPX? Well, I didn't
IMF,
buy SPX because
for
this
hosting
account has
conference,
like
and particularly this
$2,000
panel,
in it.
Pierre, Olivier, Amir, Jay, and
I want
Gita,
overnight exposure to
for
the downside.
participating. Jay, I certainly appreciate how valuable your time is, and Amir, I don't know how you find
And I'm definitely
time,
not going to
to
100%
come
the
here.
account into one
But thank you.
contract.
It is an extraordinarily difficult period, and in terms of shocks. And I know when you're giving the World Economic Outlook, Pierre Olivier, we probably always say that. But one of the things here, celebrating my 70 years, I've been around the block. And this is
He looks pretty
bad.
young
I mean,
for
I think
70.
you have to go back to the 70s to think about a period that really compares to this. And even if you don't encompass the global financial crisis, but just have the pandemic, and I don't know how to say this, apolitically, but the rather
He's
radical
Ken
shifts
Rugpull.
in U.S.
Kenneth
policy
Rugpull.
from one president to the next, and the various implications of that. The pandemic, war in Ukraine, now war in the Middle East, and this really fragmentation of globalization.
It's a lizard in a human suit.
It's really something extraordinary, and it is a very difficult period. I think that has implications for a lot
What's
of
up,
things,
Tunes?
for policy, for macroeconomics. However, before I get into that, I want to say, I can think of, there is sort of one silver lining, and I must hesitate to say it, because if I'm identifying something the IMF seems to have done right, then it may immediately go wrong. But the thing that has surprised me, and it surprised me a lot, is how we've had the pandemic, global recession, rising interest rates, inflation, and we have not had a major emerging market debt crisis. Forgive me, Argentina. We just haven't had it the way that we thought we would. You can go on to other markets. It's really stunning. And again, we don't know what's around the corner. But I actually would give the IMF a little
I'm not going to do an
credit
OI
here.
update on every fucking green candle in
There
a
was all
$1
this,
range.
for years, talk about the Washington Consensus and the evils of the Washington Consensus. And you may not have followed it, but there were many alternatives, notably the Buenos Aires Consensus between the presidents of Venezuela, Argentina, and Brazil back in the early 2000s, and much praised by many
There's quite a lot of
progressive
put interest at
economists.
40.
And
Zero DTE.
without going into the details, I would say the way people characterized the Washington Consensus was something of a caricature. It wasn't, it's sort of picking extreme versions of each policy. And yet, if we look at why haven't emerging markets had a financial crisis, it's, in a sense, they've adopted, at least in the macro sphere, and probably particularly in the central banking sphere, some version of the Washington Consensus. Now, one was to have a lot of reserves. That's really not in the Washington Consensus, and the Japan and the Asian economies deserve credit for that. And now everyone's imitated that in a dollarized world, it provides a lot of resilience. But there are certainly other elements. Regulation's gotten a lot better. And I have to say, whenever I had to sit in on meetings about regulation when I was IMF chief economist, I was sort of bored by them. But actually, it's one of those things where you do your homework and it really pays off. For example, forcing banks in emerging markets to match their dollar assets and liabilities, something really important. And not just that, but the knowledge that many emerging market central banks have about what's going on in their economies, the data that they keep track of. Certainly central bank independence, which I'll talk about in a minute much more, that's been an extraordinary development and allowed many of these things to persist. So
nice, Dan.
Anyway,
well done, man.
That has been a silver lining in a very difficult situation. So I'm going to pick up on a couple topics. I want to start with interest rates, and I'm not going to talk about policy, but just talk about where do we think long-term interest rates are going. I think, like any financial variable, it's actually very hard to know. But I think if you take a very long-term view of long-term real interest rates, and I gave a paper at this conference last year about
God, I hate economists.
With Barbara Rossi and Paul Schmelzing. You see that over the long run, there is a very gentle decline, but it's much more gentle than we've seen over the last 40 years. And there's been sort of a lot of work trying to rationalize
43, 34,
what
50.
happened over the last 40 years in
Roughly.
terms of demographics, productivity, secular stagnation, that I have always submitted has been overblown. And if you look at these longer periods, it's just, some of what seems like a structural change is just
60.
Another kind of big shock.
30,
that
43,
comes along.
34,
We've had
61.
periods where interest rates have been low.
Don't
periods
ask it
where
like
real
that. Like
interest rates have been high around
there's
this
more
trend.
than one value
And
that's
typically,
correct.
when you see a really big shock, first, like after 2008, where global rates fell, by some measures, up
Fuck
to
you, Bob.
global 10-year inflation index rates over 3%. You should never have expected that to be permanent. And of course, the same might have been true how much it rises here. It's difficult to tie the trend exactly, but what is certainly true is long-term rates typically are very volatile. That was somewhat masked during, I think, this period, particularly of the zero bound, which the chair of the Fed has talked about, where the central banks just couldn't do anything. And that provided, I think, took away some of the volatility. My own guess is that we'll be looking at significantly higher interest rates, certainly at least like they were a year ago, and I'm talking about forward-looking real interest rates, and perhaps higher for the rest of the decade or more. Again, there's volatility around this, and I'm talking about the long rate, not the short rate. And yeah, I think there are many reasons for this, but one is deglobalization probably puts upward pressure and fragmentation on interest rates, both in terms of risk premia and in terms of
tick
where
up in short put
goes.
selling.
Another thing I have to say, unfortunately, is there's, in addition to the green transition, we are looking at a decade, 2 decades of much higher spending on defense globally. I've been to conferences at the IMF not so long ago. And Olivier knows this, not him as a speaker, but we were jointly organizing one where one of the speakers insisted, well, we never have to spend anything on defense again. So, the interest rates are low, everything's a free lunch, and we should take advantage of that. Unfortunately, that was very sanguine, and we're in a more difficult period there. I've mentioned the green transition. Inequality is something which has put probably downward pressure on interest rates, but there's strong pressures in the other direction. Let me say a few words about central bank
Why do you
independence,
dislike
which
economists?
I think,
Besides
has been,
being a waste of time and
incredibly
space,
important to maintaining stability
they're
that we
financial
have.
philosophers
And it's
that
something that's
attempt
become very
to
important,
manipulate market
worldwide.
data to
I have
support
mention
whatever
when I was at the
horseshit
IMF
conclusion
as a
they've come
very
to.
junior economist. I don't know what it's like now, but you were only allowed one chair in your office for you, because who would want to visit you? That was what people.
They like
said.
to use
But
the
I
smoothing
wrote a
effect of
paper,
long time
inspired by Paul
periods
Volcker on,
in order to make the
how,
pieces of the
central
puzzle
bank
fit.
independence
But really,
might,
economists are like
help
that kid
with
in
the
elementary
inflation
school
problem
who had to
today.
wear a helmet
I
and
wrote
would
about
bang the
the
puzzles
original
together.
title of the
Instead
paper
of
on
like
inflation
making the
targeting
puzzle
in it,
pieces fit, he
but
would just
it
kind of
has
try to
inflation targeting in
fucking
it
jam
and,
the piece in.
looks at intermediate targets.
You remember them?
And
That's what
I will
economists are.
also say that I mentioned this morning about how hard it is to get papers published when you're junior. I couldn't get this one published. I submitted it. One place I sent it was to the JP, where Barrow sent it back by return mail saying, look, there's not going to be an institutional solution to this
That was
problem.
me.
It's a super game.
Sorry to hear
I
that,
got
Carl.
it rejected by IMF staff papers at the time. But I think it's certainly something where.
So I'm an economist. You
it's
can if you want to
become,
be. Yeah.
Very successful.
You don't actually have to have any academic background
I
to
will
be an
say
economist.
that in sort of trying to apply it, you have to have some humility. You can't think there's some rule that just explains everything. Your inflation targeting rule, the world changes. And models, let's face it, are particularly bad at turning points. If your model's predicting that tomorrow's going to be sort of like today, we do really well at that in those models. They're very complicated versions of that, but they're all the same. But when you have a big turning point, and we might have a turning point now, because of many factors, it's more difficult. So let me just talk about a few of the pressures on central bank independence today, and it's a fast-moving thing, and so I'm not even sure I'm nearly up to date. But during the zero-bound era, people said, well, you don't have anything to do to central banks, so you should solve inequality, you should solve the environment, you should solve racial justice, and on and on. And you can see this in central banker speeches. I haven't checked Mir's or Jay's, but you can see this. They're under tremendous pressure to address these issues. And people say, well, you can walk and chew gum at the same time. But there's a question of whether they have the instruments to do that. They're regulatory instruments, but they're very second order in most countries. The central bank's not the only one. And the interest rate is a very blunt instrument. We're certainly, it's possible with these inflation, having experienced inflation and these different times, it will change.
They just like to hear themselves talk.
I cannot overstate these pressures that I just mentioned on central bank independence. So let me give you, give you a couple of data points on this. First of all, a friend of mine retired recently.
That's not data, you fuck.
Research at a regional Fed, I won't name it, wasn't on the East Coast, and said, I was the last one working on monetary policy in my department. We have 9 or 10
So let me give you guys some data on this.
All these other issues, inequality.
This friend of mine.
Weather, but they're not working on monetary policy. And I'm sure that's changed, but I don't know.
No, tell us more about your personal experiences.
Certainly the other data point I would put.
That wasn't a fucking
the
data
American
point.
Economic Association does a survey every 10 years with pretty similar questions. And okay, I don't always trust surveys, but since this one says
I don't trust you.
I'm going to cite it. They polled 500 or 600 people at the AEA convention.
Oh,
year.
fantastic! You pulled people at an
there
economics
were a few
convention about the
questions. I'll just
economy.
pick on one. In 2000,
That's not a
they
biased
asked,
group.
Should
Impartial sample set you've got
the
there.
main,
No wonder your
who should
fucking
take
paper
the
got
lead
denied.
in short-term stabilization policy, the Federal Reserve or fiscal policy. And in 2000, it was like 75-25 monetary policy. I don't know where the 25 came from, but they had that. And then it flipped in 2020, which is really hard to get your head wrapped around when you think about how political.
No, it's not. It's a fucking survey.
What's going on in the U.S. right now? I mean, the idea that they're going to be able to perform surgery on the macroeconomy is scary. There are lots of things fiscal policy should do, and there's a big shock.
Fiscal policy doesn't do anything.
It's different. I have to mention one other question, which
is
I
the
just
U.S.
have time
Fiscal
for,
policy is
that
just
they asked
spend more
was,
money.
Should the main goal of the central bank be stabilizing inflation, or, and then they list jobs, which actually is in the mandate, but a whole bunch of
This guy's a
other
bright
things,
future as a super stock
and
DD
so
writer.
in 2000, we still had the
He might be
inflation.
one. You
Inflation
never
was
know.
The answer, again, it was about 75-25, and it had completely flipped that, well, don't worry about inflation, by 2020. I think that was before we'd hit this turning point, and maybe it'll be different going forward. Anyway, thank you.
Thank you, Ken. That was absolutely terrific, as we expected. So we've not been disappointed. There's been no turning point on that, at least.
I love that he
he's
is molding the minds of our
there
future
are
economic
some ways
leaders.
in which central banks are asked to do much more than just monetary policy. Let me maybe open it up to the panelists and see if anyone wants to react to the points that have been raised by others before we then take questions from the floor. So anyone wants to? Gita, please.
Amir, if I may, you briefly mentioned about the use of FX intervention. And I said in my speaking points that it's a pretty tricky thing to tell apart when to intervene and when not to. It'd be great to hear from you how you think about that.
I think one lesson that we learned through economic history is that when financial crises intermingle with real crises or other events, you can think of COVID as a health crisis, went into an economic crisis, and through a lot of the work of the Fed, we sort of averted a financial crisis, but we know those are the deepest, those have a magnifying effect when the two interact, and that's why when this event had started, it was, and we could already see there was a lot of things going on in Asia and other places regarding the shekel. That was the logic. You want to ensure stability. You want to make sure the markets function. You don't target a particular exchange rate, but you want to moderate things such that the markets function. There is liquidity. And that was our goal. And I think, as of now, as I showed you, the exchange rate sort of through events, obviously it's related to the events that are actually happening in Israel as well, but it gave it time. It didn't drift into panic mode. And that was the role of, and still is the role of FX intervention. When you have risk premia go up, that's the number one concern. There are people, when it happened, immediately say you should lower interest rates, help the economy. No, the two go hand in hand together. The idea was to stabilize the exchange rate. The exchange rate stability had periphery effects on the bond market and the stock market in Israel. They continue all to function. We came with the other prong approach with the targeted things for the households. And that was the way we sort of aimed at it.
So if I can, and in the meantime, if you are planning to ask a question, I will ask you to go and put yourself behind one of the mics so we can directly move to the questions afterwards. But before we turn to that, let me actually follow up with one.
Well, they're talking about monetary policy, not banking.
I mean, Jay, there's this incredible resilience in the U.S. economy that Gita mentioned. We've had this decline in inflation, and the economy seems to be powering ahead. Growth is really at a very high level. Consumption is very, very strong. There's this question about whether transmission of monetary policy is different this time around. Now, in your remarks, you've alluded to the fact that the sequence of shocks we've had is quite different from the typical business cycle. And so I was curious, and I would like to ask the same question to Amir, because in the context of the tightening of policy that you have done in at the Bank of Israel, and maybe some of these resilience that Ken was talking about, building a stronger monetary policy framework, building reserves, et cetera, whether there is a sense in which the tightening operates in slightly different ways, there are longer delays, shorter delays. How do you view this from your own vantage point?
Go ahead.
So I would say a couple things. Clearly, the U.S. economy has been stronger than expected. It's been more resilient, and this year is just remarkable, really. So many forecasters had a recession this year, and it's nothing like that. It's going to be close to 2.5% growth this year. But that's probably, in my thinking, probably significantly a function of strong demand. I think monetary policy is generally working in the ways that we think it should work, which is interest-sensitive spending, asset prices, exchange rate. I think there are some aspects of the U.S. economy where you can argue that it's a little different, and that would be, for example, households who are in low-rate mortgages are not selling their homes, but they're also not feeling the effects of higher rates because they really don't want to get out of those mortgages. Same thing with companies. Any company that had access to fixed rate borrowing and didn't use that in the last 3 or 4 years would be facing, but there are very few companies that are in that. So it may be that the U.S. economy is structurally a little bit more resilient to interest rates, but I don't think that I don't see at this point anything that seems to be structurally or materially in the nature of a difference.
Amir.
I sort of agree with Jay. I think the famous long lead, lags, it may be a bit longer. Partly people came out of COVID with a lot of savings. So the potency and the effect of monetary policy took longer, the adjustments of both supply and demand. But I think at least Israel also had, as I shown, a very strong recovery, and we are still above trend, but we're slowing down. So the effect of monetary policy was kicking in before this whole event. Inflation was probably on its way to our target in Q1 24. It just took, in my opinion, a little bit longer for these adjustments to happen. I also agree with Jay in his speech that the issue of supply, to look through supply, was there's a time to do that, but once inflation gets too high and too long, the expectation channel is so important. And as long as that was anchored in monetary policy, ultimately would kick in. It did take a little bit longer.
Okay, Jay.
I just want to, for a second, go back to something that Ken talked about, which is central bank independence. Unsurprisingly, I'm a believer in central bank independence. But it really is just an institutional arrangement that exists because the elected government allows it to exist, and as long as it serves the public well, it's a fine institutional arrangement. And I think it's easy to forget that we have this precious independence. It should be very, very rare in a functioning democracy that you have an institution that has the degree of independence that we have. Of course, we strive all the time to be democratically accountable and transparent. But I think that the temptation to wander into exciting new issues that really are the business of the elected government is a strong one and is to be resisted. And because I think that's, when I think of ways that independence could be undermined, to me, that's right at the top of the list.
Very good. Any other reactions or comments?
Well, I would just add to what Jay just said. I think many economists, particularly over the last 15 or 20 years, just take it for granted, and they have these very sterile technocratic models and don't realize that central bank independence is something central bankers have to fight for every day. It's a very political environment with which they have to protect their right to do monetary policy independently.
Very good. So with this, let me open it up to the floor. So I'm going to start with Martin here. Please state your name and your affiliation, and then I'll move back and we'll alternate. So Martin, you go first.
So Martin Stürmer with the research department here at the IMF. Governor Yaron, thank you so much for joining us during these terrible times. I hope that you can live in peace very soon. Now, what are the scenarios that you are preparing for? What are the worst case scenarios that you're thinking about?
The projections that we gave, as I mentioned, were contained to a situation where most of the war is really at the southern border. It takes until the end of 2023. It doesn't mean there's no interactions in the war in the north, but there isn't a full-fledged transition into a war there. That's a different ball game. It will have a different impact. There's enough uncertainties even around just the issues of the southern border, just dealing with the southern border, how comfortable people will be coming back to some of the activities around there. The north border will be, if that happens, and we all hope that doesn't happen, this could have a much bigger implication. Is just a different scenario altogether.
Thank you. I'm going to go to the back, the lady over there. It should be working.
Hi, I'm Vivian. I'm an economist here at the IMF. My question would be to Mr. Powell. I wanted to hear your thoughts on a subject that Gita touched upon, which is the recent movements in the yield curve in these last many weeks. And I wanted to know if you think it's a change in natural rates, so maybe Fed funds rates should be a bit higher, or this is just a steeper yield curve, like higher term premium, so maybe Fed funds rates could be lower. And also, I'm a bit worried about over-tightening on a personal level, of course. So what would be clear evidence for you that rates are in restrictive territory enough, given the lags? I mean, we could be over-tightening. That's it.
Thank you. So on your first question, on the implications of higher rates, it's when we move the federal funds rate around, the real point is to affect broader financial conditions, and broader financial conditions then affect the economy, the real economy, in ways that we broadly understand. But so we don't target any one financial condition. We look at broader financial conditions. So it's very hard to draw a direct line from one particular thing like higher bond yields to what monetary policy should do. So the first thing you would look at, though, is you'd look for persistent changes. Even then, and so then the question is, and Gita touched on this appropriately, which is why are longer run rates going up? And it really, the reason they're going up really matters, so we have to factor that in. So it's something we're looking at. We're certainly not going to ignore a significant tightening in financial conditions through that channel, but we don't have to decide. We're moving carefully now. We've moved very fast, and rates are now restrictive, and so we're going to be looking at this question, and not something we're trying to make a decision on right now. In terms of, I take your question to be, why are long rates higher? I think there are many candidate explanations, and 5 or 6 of them, it's easy to get to a half dozen explanations. I think we really don't know. I think one thing to point out, though, is people are experiencing these higher rates are actually affecting people's mortgages. The costs of all their floating rate debt is being affected. So it's having an effect on the economy. You know that the standard thinking has been that this was largely about term premium. Then the question is, why term premium? I don't want to try to dive into all of that today, but it's something we're looking at carefully and just seeing. In terms of you mentioned over tightening, but how are we thinking? So I would just go back. At the beginning, really the question was to move as fast as we could. As I went through with the chronology, in early 2022, it became obvious that we needed to tighten policy as quickly as we could, and also at a reasonable pace. So we did, and that was the main thing, was speed. The second question was going to be how high to go, and we're still on that question. We're still on the question of a policy stance that's sufficiently restrictive to bring inflation down to 2% over time. The next question will be how long to keep rates restrictive. And so we're looking at, there is no magic to it. We're looking at the incoming data, of course, but really we're looking at the implications for the outlook. It's really what are we learning about the outlook, the balance of risks, and all those things. And we're trying to make a judgment at this point whether we need to do more. And as I said, we did move very quickly. The speed is no longer, the main thing. The main thing now is to try to get to that right level. Of course, we don't want to go too far, but at the same time, we know the biggest mistake we could make would be to fail to get inflation under control. So that's not going to happen. We will keep at this until we succeed. So moving carefully and looking at all the evidence and trying to make smart decisions on behalf of the public.
Let's go in the front here, sir.
Thank you. I'm Charlie Kimball with the Korea Center for International Finance. Both in the United States and presumably in Israel, in 2020,
did you say
fiscal
Korean?
policy and monetary policy were in line. And now they seem to be at cross purposes. That is, we have very easy fiscal policy here and presumably in Israel. Does that mean that the real rate of interest that you should aim for should be a little higher?
Amir?
Amir, do you want to go first?
I think this situation, I'm not sure we're in different situation right now in the U.S., so I think, the job of the government in this kind of an emergency war situation is to supply the needs of many of the people who've gotten hurt from the war, and to try to minimize as much the damage that might be from this event, and that require fiscal spending. There's also, obviously, as Ken mentioned, there's likely to be more military spending over time. And the point that I was alluding to was that we need to find the right balance where, on the one hand, these spending be done, and at the same time go and very carefully find less needed, or especially given the circumstances, items in the budget, and direct them into those spending avenues, such that the fiscal stand over time, and we've demonstrated very responsible fiscal position, and I believe that if we do that, while the debt to GDP of Israel will go up for a while, the fiscal position will retrieve back and fundamentally can avoid structurally changing. But that require to do these appropriate adjustments over time that I mentioned.
So first, the thing to say is that we stay very far away from commenting on fiscal policy, even indirectly. So I won't do that. But I will say the way I'm thinking about this is let's look at where real rates are. So the federal funds rate's at 5.3 and change. If you take a 1 year forward look at inflation, maybe that's 3. So you've got real rates that are above 2%, and that's well above most mainstream estimates of where the neutral rate might be. I think that our star is as a not a particularly useful way to think about policy, because it can be affected by so many things and it changes over the short run and the long run. So I think I tend to look at it that we're in the range, we're in the place where we have restrictive policy, and probably significantly restrictive policy, and we're watching the effect carefully on the economy. I think the question of, has the neutral rate risen or will it rise, and will that be because of this factor or that factor, is less interesting given the policy job that we have to do. Of course, we have all the models and we look at them and things like that, but really I think about it in a more practical way.
Final question, sir.
Dr. Mamadouba from Howard University and Athletic International University in Hawaii. Actually, the biggest problem in the world economy is inflation. Why the Fed did not change its fundamental goal from unemployment to inflation? If you understand.
I'm sorry, could you repeat that?
Yes, actually the fundamental goal, the biggest problem in the world economy is inflation. Why the Fed, your bank, did not change its fundamental goal from unemployment to inflation like the ECB?
Great, thank you. So we have a congressionally set mandate of maximum employment and price stability.
Why did the Fed Why did the Fed change their goal from
inflation and we can't change them? Only Congress can do that. We do have a provision. The question is, what if we're very far from one of those goals and not so far from the other? And what we do is when we say this in our constitutional document that we've written, it's not a matter of law, but our policy would be to focus on the one where we're farther away from the actual goal. So 2% inflation, we were a year or so ago very far from 2% inflation, and that has been our focus. As inflation comes back down, it becomes more of an equal weighting thing. And when you're equally far away from each goal, then the two are equal because they are exactly equal under the law.
Thank you. So I want to thank our panelists, but I would like to give a chance to Ken to maybe have a final word, since this is this whole thing is for you. So
I think people were pretty interested in hearing everybody else in this particular panel. I will say on this last question about fiscal dominance, it's a very different thing when you're at war and fiscal spending's taking up, I don't know the number, but half of GDP suddenly. Defense spending's taking up half of GDP suddenly, and there's no country which looks at its inflation targeting framework exactly there. Nobody does that. I don't think anyone fully did that even in the pandemic. You don't have to comment, but I mean that had a certain war-like feel at the beginning. It's a very different situation where you really need to reach into the toolkit because the national objectives are now very different than just unemployment and inflation.
So please join me and let's thank all our panelists today.
All right. Well, that was fucking boring. He wasn't that neutral. He was pretty hawkish. He started off by saying he doesn't feel that the Fed has done enough, which is a pretty bold statement. GME's getting cucked. Well, yeah, the market's dropping. What do you expect? Because that's what I always want to buy into when the economy's failing, is mid caps with no growth prospects. Yum. Close that fucking door, Powell. 3% swings on Treasury is normal. Totally. I mean, they've got it. They got it a little bit under control. It's down from 4.8 to 4.775 on the 30-year. Although I don't feel like things are getting better. CPI is going to be interesting next week, especially if it's hot. Ooh, if core is hot. I think it's been enough time since oil spiked. So where from here? Who's positioned best into end of day? Bears are, but bulls are still fighting for their call wall at 43.50. They already lost all their other positioning, so. I mentioned before that 43.50 would probably be defended. I think last night and the prior night. It is defended. We can still lose it. There's a concentration of interest at 43.40, 43.35. That's also bearish. The majority of interest at 43.50, while bullish, is not significantly so. So the distribution of potential closing prices is weighted to the downside. Ooh, I'm gonna use that from now on. That's a way easier way of shutting everyone up. I like it. Huh. Why was cat affected? Everything was affected. Imagine being a greedy bull for 9 days. Here's what I can't imagine. Imagine people that were buying 44.50 calls. There were people buying like a decent chunk of 44.50, like 30 DTEs. That was just stupid. Why was cat affected? Is it the same question? I'm losing my mind. Oh, okay. Mag 7's still positive for the day. Is it? Broadly? I don't think so. NQ's down 86 BPS. I think you're wrong. Apple's down 50. And Microsoft is down 50 BPS. And that's the majority of the Mag 7. Amazon's down 100 basis points. Tesla's down 588. Yeah, no. The Mag 7 is not fucking up today. What's with HBM getting murked? Ooh. I like that. Looks like delayed gold sales. Fudge their EPS. That's good though. When gold's volatile or picking up volatility like this, it's good that they're holding their and not selling. So enjoy the dip. How much fucking HBM do you have? It's only down 2% today. How are you down 10%? Imagine a close on SPY down here like 43.50, 35. Still a healthy pullback from 4,400 or a true pivot. What do you think? I think we need to lose delta neutral before it's a true pivot. And really, we probably need to lose like 42.75 or 42.50. This is kind of the range where I'm worried that short positioning will get overcrowded. Positive economic data will come in, and bulls will squeeze the fuck out of the shorts and get gamma max. Or maybe higher. Because gamma max is going to move up on this. Opex is next week. What do you mean, for GME? I don't fucking know if it's going to run or not. It's a pile of shit. It might. Can you give an end-of-week Tesla prediction? Not really. Tomorrow's Tesla's 0 DTE day, and all the bulls are going to think it's oversold. So I'd be cautious that put profit taking at the 207 resistance could lead to a bounce. Might not be a very good bounce. Jimmy is the reason your channel exists initially. What's your point? Be grateful? No. There's no gratitude in financial markets. Just like there's no altruism. Can you dump it into her clothes, Captain? We could. We could dump into clothes. But that's how we found you, through GME. I probably would have been better off popularity-wise if I'd never covered GME. Right, like if I started this stream and covered other shit, I'd have a way bigger audience. Like AMC, yeah. Everyone in here has one thing in common, GME bags. That's not true. A bunch of people already sold them. Imagine becoming educated and learning new things and not changing your opinion about anything. That's America. You're an acquired taste, like an aged cheese. No, I don't regret not covering AMC. It was bullshit. I wish I'd listened to myself a year ago when I said if the split happens and it doesn't cause a squeeze, we're never getting one. And just sold in August. Then I would have to think about it. I did sell in the money covered calls, so it's kind of like I sold in August, but not fully. You don't understand, Greg. We're not locked in here with you. You're locked in here with us. That's not true. Do you think we could continue going lower tomorrow? Yeah, that's possible. I did the in the money CC thing with Fubo. Knocking 50 cents off your cost basis is pretty sweet. Yeah, it is. Except on GME, it was like knocking $15 off your cost basis. How do you want to find out if XRT is on Reg Show? NYSE Reg Show list? Can we just crash the market? Then we can start the bull run of 2024. What bull run? Let me tell you something. If the current financial conditions culminate in a market crash, we're going to probably lose 5 years to a decade of growth. There's no money printer to bounce off of this time. No, you don't hope for that. That's terrible. That's not good for anybody. No one benefits from that. As long as I make $100 to $200 off that crash, I'm set. You can't get it anymore. GME doesn't run anymore. The last time I got to sell in the money cover calls on GME where there was enough liquidity was like after earnings in June, I think. Still not a bad time for longer dated puts. It's a risky time. You're worried about picking up Vega exposure, I assume. Otherwise you wouldn't really care that much about VIX's current level. 16's like the average, right? I mean, traders should do well in like a flatter market like that. Investors don't do well. That's the breakdown. So all those people are like, I'll just buy and hold shit. They're the ones who lose out when you have a big period without a lot of growth. Bipolar bear will lose a lot of money. Any news overnight or PM that can squeeze out shorts that entered today? I don't think so. Tomorrow morning's pretty light. We have Great Britain GDP, which I don't think anyone gives a shit about. I know Lagarde is speaking in the early morning. And then at market open, we have Michigan consumer. I think we have a couple Fed speakers. Yeah, just after market open, we have the Michigan consumer sentiment preliminary. Yeah, Ascot Mommy and Michigan consumers. Bostic and Logan. There we go. We're going to need a depression trading masterclass before you leave with all your crash profits. A lot of it's probably just going to be selling contours. I wish this would break down a little faster. Maybe a slow drop off into close is better. Interest is kind of just drying up anyway. There's still a lot of calls stuck up at 43.75. The ramp down to 43.25 is getting stronger. Picking up quite a lot of delta at 25, 4300, 4275, 4250, and 4200. Although 4200's probably just put selling again. Vol control exposure's ticking up. We're down. How much are we down today? 82 basis points. Yeah, put open interest is picking up quite a lot today. Uh, 45 picked up some interest, but 43.40 lost a little on that bounce. So watch for put side profit taking into the end of the day here. If we drop, especially if we drop below 43.40, I need to look at tomorrow's expiration really quick. Were the bulls ready for this, or did they get blown up hard today? All of their out of the money positioning for like the next 2 days got blown up. So they took a big hit. I don't think they were prepared for the 30-year to print that high. Please give me words of encouragement for my GME bags. Cohen's still got $1 billion to do something with. Maybe he'll think up an idea to turn that $1 billion into $2 billion. And a small French loan. Hopefully that idea is better than him buying short-term treasuries. They still have money for a buyback too. That's in the total cash on hand, but they still have approval for a buyback. It's not like a separate pool of money. No, buying long-term treasuries is not a business model, Grim 2. Can we vote you in as new CEO of GME? I think the board would first have to put me on the list to be voted in. If XRT is taken off Reg Show, would we expect immediate price action? No, but we'd expect price action within T3 to T5. What makes you think DFV is qualified to be a CEO? Like, I don't think like trading stocks or investing qualifies you to be the CEO of a retail corporation. That's what gift cards are, Sahib. No, I'm not streaming HE's earnings tonight. Hey, Greg, I've been away for quite a while, and now I don't really get most of the stuff you're talking about in the end of the day. Do you have any advice on what I can look into to catch back up? I think I have a bunch of videos that kind of cover some of the things I'm talking about. The Twitter, the Discord. Maybe if you were more specific about what you don't understand, I could help you. Instead of just broadly saying you don't understand me. What don't you understand? Do you think GME execs are thinking about price this low? I think you've fired half of them already anyway, so it doesn't matter. Most CEOs aren't qualified to be CEO. True, yeah. What do you think about 43, 80, 85 bear calls for tomorrow? Safe? Is it even worth it? I mean, they probably are fairly safe, but I don't think they're worth it. Like, they're not worth the risk reward is atrocious. God damn it. 80, 85? You're getting like you're gonna risk it's like 10% on risk. If you're gonna sell that far out of the money, you might as well slap some theta on it. Did you say Zom may slip 100 soon? I believe I said it would slip 103, but I can double check. Yeah, it was 103 that I was concerned about it slipping. It can fall back to 100. Dude, you can't sell options. Yes, you can, Popcorn Trader. What we all don't understand is how you're not a centaur when everyone is at least half centaur. Are you sure you don't have a little centaur in you? Wait, I said that. That's I said that everyone's at least half centaur. And that's accurate, because centaurs are half human. Carry trade, I have a bunch of shit on the Discord and on Twitter that I wrote about it over the last, like, literally 2 years. Well, year and a half. And then, I think I made a video about, yeah, there should be a video about bond volatility. Pretty recent, I think. Like, and I kind of cover that there. So that might help a bit. And then if you have more questions, ask me. But go check that out. Go check out the, I think, pinned posts on my Twitter, maybe. I'm not taking my shirt off, Grimsay. Is there anyone on financial Twitter you like? Not that I've run into. No problem, man. Did you yell at me? I wasn't paying attention. Don't worry about it. Ding ding. Well, that was a fun day. I guess we did close to the downside of 43.50, although not remarkably. So breakdown here is kind of interesting. If we don't, what the fuck was that? Okay. That was weird. All right, so we're kind of right up against today's fast gamma and DN. I guess DN's probably more important here. If we don't break this, our chances at a bounce are going to increase the longer we trade in this range. And given that next week is SLD, our propensity to bounce is quite high in the pre-SLD period. So I would be very cautious of moves between delta neutral and gamma neutral. I don't think that there's going to be any data this week that's going to support like a strong move back to the upside, especially after today. But be really cautious of that, because even though this is distributing, there's still longer dated call interest that's locked up like in this range right here. And that didn't get blown up today, right? And that's for a lot of that's for like 11.17. So yeah, if we don't continue to fall, make sure that you have some sort of protection for the upside here, because that'll be important. Although this could be a good opportunity to add puts, you may want to confirm the breakdown before doing so. Damn, ES volume was fucking crazy today. Yeah, so the miss kind of fell all the way to the bottom of the bear range. Well, close. Yeah, so the miss on the tail of the 30-year was a pretty big deal, and it's showing that there's really not a lot of demand for the long-term yields. And that those yields are likely to move higher again. And that's the first thing that's going to do, is that's going to scare out everybody who bought yields over the last, or bought like 10, 20, 30-year treasuries over the last 7-8 days. because it immediately tells them that they could take a huge loss on their position, right? They already did. Anybody who bought treasuries between Tuesday and today is at break even to underwater. So yeah, keep an eye on that. Obviously the wider credit spreads driving dollar up, or dollar driving wider credit spreads, however you want to look at it. And that's going to put pressure on volatility, which we saw today, and we're seeing that in the core 3-month as we see volatility leave equities and start flowing back into the indexes, and that sets us up once again for moving into that higher volatility regime. But obviously this is far from being confirmed, right? It's simply kind of stopped the flow the other way. So the breakdown of the dispersion is kind of just flat right now. If that continues, we'll see like core 1 month and 3 month move up. We are seeing yields go up, and we're seeing, you know, volatility move up, and those forward returns on the convexity and volatility moving forward, you know, are going to attract, you know, more bond portfolios towards those long vol positions again, and you know, we can kind of move back into a similar period like we saw back here. And this was like October, mid-October. And all of this still very much lining up with the time period we're in with like SLD and Opex, right? The last several pumps have been within that same time period, right? If we kind of go back to August and September, you know, we've had a pretty consistent pattern of, you know, moving up into the pre SLD Opex period, where we get a large amount of de-risking. Then, you know, the SLD settlement period and post Opex period, we tend to experience our greatest moves to the downside when everyone's all margined up and super liquid, right? I don't think this is that different. I think our current high is still below the prior month. Yeah, if we go back here, 43.93.57, 43.93.40, and now that we've failed that, that's on the monthly. That's actually really, as a technical indicator, very significant. Failing to break over the prior high for this month means that there's a really good chance that this month doesn't actually close green. Or it could close nearer flat. So you know, on the technical side, we'd be looking at 43.30, where we know delta neutral is. Obviously, that's a very important resistance. And then below that, 42.72, 42.20. As we lose those levels to the downside, not only would we gain momentum, but bears are going to gain a lot more confidence, right? And they're going to start pushing down into all that compounded Vega risk from the last week and a half. So keep an eye on that. I don't think I have a print for move yet. Probably not. Usually it's maybe like 4:15 I'll get it. But I have a good feeling bond volatility is up, and we know that bond volatility is going to pressure correlation. USD JPY also up. And what we're going to see now because of this is we're going to see participants lean on the carry trade, right? And we're already seeing a lot of it today, right? The carry trade bounced really hard, almost 20%. But as they lean on it this time, now that the YCC's changed, they're also going to pressure yen up, right? Which makes it harder for them to short yen and get the liquidity or the hedge they need for the carry trade, right? So this will be interesting because this will drive Japanese bond yields up, and if Japan doesn't step in, there's really no cap there. And as far as we know, there's no real limit to the Japanese 10-year right now. So this will be a dynamic that didn't exist before in our previous downside moves, and I'm still kind of curious as how we're going to see it play out. But something to pay attention to at least. GME didn't do shit today, down 5%. So yeah, back to that like $12 range. We could drop lower into next week, possibly. But liquidity is starting to get kind of blown out. XRT especially is getting quite low. Upstart still selling off, probably going to go lower. So Fubo back to the 264 resistance. Support here will be important, but I don't think Russell's going to turn around too quickly. And Russell didn't really move a lot on our move to the upside. And that's kind of why I went long Russell this week, was because if liquidity was going to come in and firms are going to go risk on into the end of the year after picking up all their short alpha on the big drop, there would have been a lot more demand for small caps, and there really wasn't. It's one of the reasons why this pump seemed to lack any like good structure, right? It just seemed like it was just a big push in tech and yields, and once everything squeezed off, there was really no more interest to the upside. And so Russell's probably going to drop back. If Russell falls back to where charm is negative, it's unlikely that it's going to recover anytime soon, and that'll drag Fubo's price down. So keep that in mind. Siri actually closed up today, but I don't really know what the fuck's going on with that. Yep, that's about it. So thank you guys so much. I'll see you bright and early tomorrow morning, and I'll have a write-up out tonight for everyone. Later, guys.